This is Alan Brooks. Thank you for watching the Brooks Trading Course. This is the first of two videos on actual risk. I want to begin by talking a little bit about the trader's equation and what I mean by risk when I talk about risk and reward. In particular, I want to talk about actual risk in contrast to initial risk. A trader should only take a trade if he believes the probability of success times the potential reward is greater than the probability of failure times the risk. That is the trader's equation. For example, we have a bull trend, about a 50% pullback, a slightly higher low, a high 2 bull flag, one leg down, pullback, second leg down, and a decent looking buy signal bar. It's a very deep pullback. We have 4 consecutive bear bars, but it held above the bottom of the bull breakout right here and above the bottom of the bull trend right here. It's reasonable to put a stop either below the bottom of the bull breakout. If this is in fact a bull trend, the market should not fall below this low. It's also reasonable to put a stop below the bottom of the bull trend down here. Let's say you did buy above the high of this buy signal bar and you got filled right here and you put your stop below the bottom of the bull breakout. Your risk is from your entry price, just a little bit above the high of this bar, down to your stop, which is just a little bit below the bottom of this low. This is how much you're risking initially. Different traders have different stops. Some traders might have a stop down here. Other traders might use a stop based upon money. For example, 10 or 20 pips or 10 or 20 ticks. Every trader has a different idea of where his stop should be. And therefore, there's no widespread agreement on what the initial risk is. When you take this buy above the high of this bar, some traders will get out below this bar, some traders will get out below this bar, or this bar. Other traders will use money stops. There's no agreement on what the initial risk is. Each trader has his own idea of how much he's willing to risk initially. Based upon what you're willing to risk, you can come up with a reasonable profit target for the trader's equation. You need the math to support the idea that this is a good trade. You need, again, the probability of making money times the size of your profit target. It has to be greater than the probability of losing money times the size of your risk. Is the probability of making money 60% or higher here? It might not be. It's probably less than that. In general, if ever you are uncertain that the probability is less than 60%, you should go for a reward that is at least twice your risk. Here's your risk, the size of this brown box, just above the high of this bar, down to your stop. This is 2 times your risk. If you take this buy and put your stop down here and exit with a profit up here, the math is good. The probability certainly is better than 40%, as long as the probability of reaching this goal before hitting your stop is at least 40%, it's reasonable to exit right there. It would result in a positive trader's equation. For any reasonable trade, it's always good to exit at 2 times your risk. The math is always good. It always results in a positive trader's equation. So in general, if you're not certain where you should take profits, try to take profits at 2 times your initial risk. That always results in a positive trader's equation. For most traders, it's reasonable to exit at 2 times your initial risk. You bought above here, here's your initial risk. If you try to exit at 2 times your initial risk, the trader's equation will be positive because the probability is probably at least 40% that it'll go up here before it goes down here, given that you're buying a pullback in a bull trend. As I said, there are many choices for an initial stop, and therefore there are many possible initial risks, depending on the trader and which stop he chooses. For example, you could put a stop below the buy signal bar, below the bottom of the bull breakout, below this higher low after this breakout, or below the entire bull trend. Those are all reasonable price action stops. putting a stop based upon the price action, below prior lows, for example. Other traders will use a stop based upon a measured move. For example, the height of this sell climax, a measured move down, it should not fall below this low if you're going to have a profitable trade. Some traders will use that as a price action stop, a stop based upon a measured move. From this high to that low, measured move down, stop just below. Or from this high to that low, and a stop just below the measured move projection. Other traders like money stops, risking a certain amount of money, a certain number of ticks, a certain number of pips. For example, this might be 20 pips or 20 ticks below your entry price. All of these are reasonable stops, and different traders will use different stops, and therefore everyone has a different initial risk. The trader who bought above the high of this bar and used a stop here, that's his initial risk. The trader who has a stop below here, his initial risk is all the way down here. We have a bull breakout and a follow-through bar. Now the probability is we're going at least a little bit higher. Here we have a strong breakout. We have 5 consecutive bull bars and a close above the prior high. Once you see this or this, traders will raise their initial stop to below the most recent major high or low. Once we get a breakout to a new high, it's a bull trend as long as it remains above this low. If it falls below this low, the market then is either in a trading range or in a bear trend, in which case you don't want to be long here because you bought this based upon the premise that you're in a bull trend. All of these traders who have stops down here, once the market gets here or here, will tighten their stop to just below the low of this bar. At this point, everyone agrees where the stop should be, below the most recent major high or low. And now everyone sees how big the deepest pullback was after the entry. If you bought right here above this buy signal bar, the deepest pullback was maybe to the low of this bar, maybe to the low of this bar. Once the market is up here, you can look back and say, where did I have to have my stop to minimize my risk and not being stopped out? Where would have been the absolute best stop on this trade in hindsight, looking back? Where is the smallest stop that I could have used and not be stopped out? You don't know that until the market has gone your way. And that brings me to the topic of actual risk. How much did you really risk on the trade? The bulls bought here above the high of this buy signal bar. You have a strong breakout here or all the way up here. At some point, you're going to raise your stop. But in any case, once you have a reasonably strong breakout, you know how much money you had to risk to stay in the trade. When the market is here, if you entered right here above this bar, the tightest stop that you could have used was right below the low of this bar. So the actual money that you risked on this trade was from your entry price to this theoretically perfect stop, which you did not know existed until the market went your way. Once the market is here and you look back, this stop is probably the tightest stop that you could have used that would have avoided you being stopped out of your trade. From your entry price to that stop just below the low of your entry bar, that is how much you actually had to risk on this trade. Your initial risk might have been here, it may have been here, it may have been here. Different traders use different stops, and therefore their initial risk was different. But every trader who bought above the high of this bar at this point knew that his actual risk was just to below the low of his entry bar. All of the traders, no matter where their original stop was, now know that they only had to risk this much in hindsight. Here we have a high 2 bull flag. We have a bull trend, high 1 bull flag, a high 2 bull flag. A reasonable initial stop is below the bottom of the bull breakout, maybe below the bottom of the bull trend. Let's say you put your initial stop here, below the bottom of the bull breakout. Then your risk was from above the high of the entry bar where you got long, down to your stop just below the low of that bull bar. The market pulled back, did not quite reach your stop, and then it went your way. However, once the market did this, a strong breakout above your entry price, you now have a good idea of what you actually had to risk to stay in the trade. All you had to do was risk to below the low of this bar. If your stop was just a little bit below that bar, that's all you needed to not have been stopped out. It's less than your initial risk. You did not know that this was the perfect stop until the market went your way. But once you were up here and you look back and you say, what was the smallest stop that I could have used and not have been stopped out? It's 1 tick or 1 pip below the low of this bar. So right here, this is your actual risk, your entry price to that theoretically perfect stop. Actual risk, entry price to the perfect stop. And any trader who bought here or anywhere through here, once the market is up here, he can look back and say, this is a major higher low. His actual risk was to just below that low, and it doesn't matter where he bought through here or anywhere in here. It doesn't matter where his stop was. At this point, the actual risk for any of these bulls is just below the low of this bar. You have to get out at some time, so you have to have a logical plan to take profits. As I said, there are many choices for an initial stop, which generates the initial risk, and therefore there are many possible profit targets if you're using initial risk to generate your profit target. However, once the market starts to go strongly in your direction, you know where the perfect stop had to be, and therefore you know what your actual risk was. And that's true for any trader who bought anywhere in here. His actual risk was to just below the low of this bar. The bull who bought above this bar, this is his actual risk. Computers often use actual risk to create profit targets. So for example, computers who bought above the high of this bull bar for a high 2 bull flag, if they put a stop down here initially or a stop down here, they did not get stopped out. They held long despite this pullback below their entry price. Once the market started to go their way, they would generate profit targets, many of them using actual risk. Their actual risk is the height of this blue box down to where the perfect stop was, and therefore 1 times actual risk is the top of this blue box right there. Since they're buying in a reasonably good bull trend, many of them will get out with a profit that is equal to 1 times their actual risk. It was a reasonably high probability trade when they put it on. It became lower probability after this pullback. Most traders would be happy to take at least partial profits once the market went as far as they actually had to risk on the trade. And you can see what happened when it got up to 1 times actual risk, it sold off. When it got up there again, it sold off again. That tells you that a lot of computers used actual risk to generate a profit target. Whenever you're taking a trade where the probability is high, in other words, you're fairly certain you're going to make money, the probability is at least 60%, otherwise you would not be certain, the math is always okay to go for a profit target that's equal to 1 times your actual risk. However, it's always good to go for 2 times your actual risk. Sometimes it's unrealistic. If you bought here and you were disappointed by the size of this pullback, a lot of traders would simply try to exit at 1 times actual risk. On any trade, the math is always good to go for a profit of 2 times actual risk. Here we have profit taking at 1 times the actual risk, and that tells you that computers are taking profits there, and they took them again up here. And that tells you that exiting at 1 times actual risk in a high probability trade is a reasonable thing to do. Profit targets lead to pullbacks, and therefore they are resistance in a bull trend. When the bulls take profits, the bulls are selling, the bears are always selling. The bears know where the profit targets are as well, and they'll sell up here as well. In a bear trend, where you take profits in a bear trend creates support. The bears buy back their shorts. The bulls know where the bears are buying back their shorts, and the bulls buy there as well. You usually get some kind of a bounce. The bulls take profits here. The bears know the bulls will take profits there, so some traders will sell for a scalp at that profit-taking location for the bulls. Some of the bulls who bought here will buy more lower above a bull bar, so they'll add to their position right here. As long as they believe that the market is still always in long in a bull trend and that it will go higher, they'll continue to add on lower, especially above bull bars, as long as the second entry is at least the size of a scalp below the first entry. Many traders who bought here and bought more here, as long as the second entry is at least the size of a scalp below the first, they'll take profits when the market gets back to their first entry. They get out break even at their first entry and then with a scalp on their second entry, and you can see the hesitation when the market got back to their first entry price. When you look at any chart, 90% of the bars are in a channel or a trading range, and that means the probability is not especially high, and therefore a reasonable minimal reward is always 2 times actual risk. If the actual risk is too small, a lot of traders will go for a reward that is 2 times initial risk. 2 times actual risk always results in a positive trader's equation, and since initial risk is almost always at least as big as actual risk, if you go for 2 times initial risk, that will also always result in a positive trader's equation. Let's say a trader saw a bull trend, a 50% pullback, and they bought above the high of this bull bar. Their idea is either it's a pullback in a bull trend or a pullback in a trading range. Maybe the market will simply go up to that high and go sideways. In either case, it's a reasonable buy. And let's say he puts a stop just below the low of his buy signal bar. Then his initial risk is from his entry price here to his stop just below his buy signal bar there. As I said, the math is always good to take profits at 2 times actual risk or 2 times initial risk. Here's 1 times initial risk right here, and here's 2 times initial risk right here. Therefore, it's mathematically reasonable to take partial or full profits here if you bought there and put a stop here below your buy signal bar. We have a breakout here, a pullback, and a strong buy climax. If you're buying this close, you need a wide stop, either below the buy climax bottom or below the bottom of the bull trend. Let's say you buy that close and you're disappointed by this, but your premise of a bull trend is still valid in your mind and you rely on your stop. The market starts to go your way. Actual risk is from your entry price, which is buying this close, to just below the low of the pullback. This is the size of your actual risk. You bought a strong bull breakout, 60% chance you'll get a move up that is at least as big as your actual risk. This is your target up here. Here's your actual risk from your entry price to your stop. That's how much you actually had to risk. This is a reasonable target, 1 times your actual risk in a high probability buy. Yet we have a double top here. The bulls tried to get to that target here and failed. They tried strongly to get to that target and failed again. What do? I would exit longs. Since the bulls twice tried to get to their target and were unable to get there, and we have 2 decent bear bars, the market traded below, and if the market goes below here again a second time, it's a second entry sell, maybe for a wedge. 1 reversal down, 2 reversals down, 3 reversals down, and now a second entry. it's reasonable to get out here even though the market did not reach your target. Your premise is no longer valid. You bought what you thought was a bull trend, and now we have a wedge top or a double top. I began talking about the trader's equation and risk. There are actually two kinds of risk. Initial risk, the distance to your stop. Everyone has a different stop location, and therefore everyone has a different initial risk. Once you're in a trade and the market strongly goes your way, you can look back and find out where the perfect stop had to be. Where would you have had to have a stop so that you would not get stopped out? That is your actual risk, from your entry price to the perfect stop. I'm Al Brooks. This is the first of two videos on actual risk. Thank you for watching the Brooks Trading Course. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of two videos on actual risk. Sometimes the market will allow you to use a very tight stop, and therefore your risk can be small. Sometimes, even if your initial stop is big, your actual risk is small as well. When the risk is small, do not use the small risk to calculate a profit target because your profit target will be too small. However, if the risk is reasonable, then you can use it to find a profit target. Remember, the trader's equation has three variables: probability, risk, and reward. And a default for taking profits is 2 times your risk, assuming that your risk is at least as big as a scalp. The market had 2 very big bull trend bars, and it pulled back. We have a small bull inside bar. It's a high 1 bull flag. It's reasonable to buy above the high of the bar. The market immediately went your way. It never fell below the low of the entry bar, so your actual risk was never any more than just below the low of that entry bar. A very small actual risk compared to the size of the bull breakout and to the size of the bull trend that followed. 2 times actual risk is right here. Mathematically, it's always reasonable to take profits at 2 times actual risk. That results in a positive trader's equation. However, that is the absolute minimum to make the trader's equation positive, and that is not necessarily the best. When the actual risk is very small, but the probability of a big profit is very big, you should not use the actual risk to calculate where to take profits. Remember, that is the absolute minimum that makes mathematical sense. However, doing the minimum is not necessarily the best. For example, if your kid graduates from college with a D average, that might be the minimum that the school requires to get a diploma. But you would not be happy with that because he would have a hard time getting a job based upon that minimum. In general, when you have a very strong bull breakout like this, the market's probably going higher, probably at a minimum based upon a measured move using the open of the first bar to the close of the final bar. 60% chance you'll go up for a measured move, which is far greater than 2 times your actual risk. As long as the market is strongly bullish, I think it's better to use other types of support and resistance to determine where to take profits, such as measured move targets, trend lines, and prior highs and lows. 2 times actual risk is resistance, but you can see the market is ignoring it, and the market went far above it. Again, using actual risk gives you a mathematical way to take profits, but it's a minimum, and minimum is rarely ever the best choice. Strong bull breakout, 60% chance you'll get a measured move based upon the height of the breakout, either the low to the high or the open of this bar to the close of that bar. 60% chance you're going up here, so it does not make sense to exit at 2 times actual risk. When I say 60% chance of going up here if you buy here, that's if you use a stop based upon the bottom of the most recent major low, which is here. If a trader buys above this bar and puts a stop below the bottom of the bull breakout, he has a 60% chance that the market will reach that target before it hits his stop below. That is his initial stop. Once the market started to go his way, he would then tighten the stop to the bottom of the most recent breakout here. You can see the pullback here, and that tells you that some traders are taking profits based upon a measured move up based upon the height of this bar. When the stop is far away, traders need to control their risk, and the easiest way to reduce the risk of having a stop that is far away is to reduce the position size. And when traders do that, you get a pause in the trend or a little pullback. Spike, tight channel, and every channel eventually evolves into a trading range. And that's what's taking place here. We're starting to get doji bars, pullback, more pullback, breakout, not very big, tail, not great follow through, bear bars. It looks like we're starting to evolve into a trading range. And when that's the case, it's no longer in a strong bull trend. You have to trade it differently. And bulls are more willing to take profits, for example, below a bear reversal bar. Spike, pullback, second push, pullback, third push, a small spike and channel wedge. Since it's no longer a strong bull trend, traders will no longer trade it like a bull trend. They'll begin to trade it like a tight trading range, which means that they have to exit their longs, or at least a good part of their longs. We have a pretty good bear breakout here. We had two legs up, one pullback two, and a strong bear breakout. And now we entered a tight trading range, double top bear flag. Here's the first high, second high, and you have a bear bar closing on its low. It's reasonable to sell below that, looking for at least a small second leg down and possibly a bear trend. If you did sell below the low of this bar, the market sold off without coming back. It never came back above the high of the entry bar. Therefore, your actual risk is no more than just above the high of that entry bar. It may have gone to the entry bar high after you entered. You don't know that, but you do know that it never went above the entry bar high. And if you had a stop above that entry bar high, as soon as you entered, if you put the stop at that line, you did not know it would be the entry bar high. But had you entered and put your stop there, you would not have been stopped out. In hindsight, that is the tightest stop that you could have used to avoid being stopped out. And this little green box is the height of the space between your entry and that stop. That is your actual risk. It's always mathematically acceptable to take your profits at 2 times actual risk. But when you look to the left at the size of the swings, exiting with that small a profit is probably not the best choice. It may be mathematically okay to do that, but there's probably going to be much more profit remaining in the trade. Strong enough breakout so that probably a 60% chance of the market falling for a measured move based upon the height of the breakout before it gets above the top of the breakout. So if a trader sold below this bear bar and put a stop up here, 60% chance it would get down here before it hit that stop. Therefore, this is a good, reasonable minimum goal. And you can see the tails and the sideways move down here. It tells you that there was some profit taking here. Traders, in fact, did take profits at a measured move down based upon the height of that bear breakout. Why would they do that? Well, their stop at this point is either at the top of this sell climax or the top of this bear leg. In either case, it's far away, and they want to reduce their risk. The easiest way to reduce their risk is by reducing their position size, and that profit taking results in a pause or a bear flag. A small double top bear flag, reasonable to take a short, selling below the low of that sell signal bar. We have a new strong breakout. Traders who did sell there could lower their stop to just above the height of that bear breakout. Because it's a strong breakout, it probably will result in some kind of a measured move down. Some bears are selling closes, others are selling below bear bars. Here, here, here. Every new breakout creates a new potential measured move down. I have the measured move based upon the top of the bear breakout to the bottom of the bear breakout. Some computers will base it upon the open of the first bar to the close of the final bar, these 3 bars, and that would be a tighter projection somewhere up in here. In any case, if you did sell here and you held short and you have a new breakout, you have a new profit target. If you used a projection based upon the height of this entire breakout, the market did not quite get there, but you're at the end of the session, it's reasonable to exit on a reversal up. We have a very strong rally and a deep pullback, a type of spike and channel bear trend, strong bear breakout, so a spike, second push, third push, and the market's reversing up from the bottom of the channel and just above the bottom of the bull trend. Also, this tight trading range is a triangle. We had 3 reversals down, 1, 2, 3, and you can call it a triangle if you want, but a tight trading range late in a bear trend usually becomes the final bear flag. The breakout usually does not go far and you get a reversal. It's reasonable to buy above the high of this bar. We have a final flag, a wedge bear channel, and a test of the bottom of the bull trend. If you bought above the high of this bar, you got filled here, the market went straight up, your actual risk was no more than to just below the low of that bar. Very tiny actual risk compared to the size of the bars and the size of the swings. Big swing up, big swing down. 2 times actual risk. It's okay to take profits there, but doing the minimum is rarely ever the best in life. And when you look at the size of the legs up and down and the size of the bars, this is probably way too small. You probably stand to make much more profit. Another approach would be to take profit at other types of resistance. For example, the top of the triangle, the top of the final bear flag. It's a reasonable place to take profits, and you can see there's a pause here, a little bit of profit taking. We're also testing the bottom of a trading range. We have a double bottom here and a breakout. These lows create a breakout point. You can see this bear bar in the tail here, and that indicates that there's some selling there. This profit taking from these bulls. Some of it might be bear selling, but with a bull trend that is as strong as this, it's probably more profit taking from the bulls who bought anywhere in here than it is from bears selling. We have a gap between the low of this bar and the high of that bar. It might result in a measured move up. And some traders would take profits around that measured move target, which is also around the top of this bear leg. Anytime you get a pause at a logical profit-taking area, it's a sign that many computers are taking profits there. If it's good for the institutions that programmed those computers, it's good for you as well. Far better than taking a minimal profit based upon a very small actual risk. Strong bull trend. Here's a high 2 pullback, a high 1, and then a high 2. A reasonable buy. Dojis, 3 dojis, so possible tight trading range soon. This is probably too tight of a stop. You're in a tight trading range, and the market may come down more before it goes up. A better stop is below the bottom of this bull breakout, possibly even below the bottom of the entire rally. However, if you're taking this buy, using a stop right below your signal bar is probably too tight. This is a more appropriate stop. You can use your actual risk to determine a profit target. If ever you take a trade and you're not sure where the profit target should be, it's always reasonable to take profits at 2 times your actual risk, or to swing trade and see how far it goes. Simply rely on a logical stop. And even if you buy this thinking you're going to scalp, I think you need a swing stop, and you should trade small enough so that you can scale in more on a pullback if you get a pullback. High probability that we're going at least a little bit higher. Actual risk, you buy above the high of this bar, you filled right here. the market went straight up, your actual risk was there, and this is 1 times actual risk, and you can see there's a pullback there. Because the trend is strong, it's a high probability that you'll make a reward at least equal to your risk, and therefore, when you're buying in a strong breakout like this, you have a high probability trade. It's reasonable to go for 1 times actual risk for your profit target, as long as it's at least as big as a minimum scalp. I want to talk more about using risk to determine profit targets. We have a bull trend, and if you want, you can call it a high 1 bull flag. You can call it a high 2 with this. You can call it a double bottom bull flag. Doesn't matter. It's a pullback in a bull trend. It's reasonable to buy above the high of this bar. Remember, if you take profits based upon actual risk, it gives you the minimum profit target that you need to have a profitable strategy, a positive trader's equation. Never lose sight of that goal. You always need a reward equal to at least 2 times actual risk. In a strong trend, you can go for 1 times actual risk. Now, if you're scalping, can you take profits based upon the initial risk instead of the actual risk? It really doesn't matter whether you take the profits based upon initial or actual risk or any other support or resistance. Your goal is to have a positive trader's equation. Anytime you structure any trade, you have to make sure that it makes sense, that you have a positive trader's equation. The minimum profit is always 2 times actual risk, but sometimes that target is too small and you have a very high probability of making a bigger profit. Another choice is to use initial risk, which is almost always bigger than actual risk. Risk provides you with targets that provide the minimum needed for a positive trader's equation, but other targets are often better. And if the context is good and the target based upon actual risk looks too small, don't exit at 2 times actual risk. Hold for a bigger profit. Use other support or resistance for your profit target. Let's say you buy above the high of this bar, and let's say your stop is below the low of the bar, and that therefore is your initial risk. From just above the high of this bar, you get filled right here, down to just below the low of that bar. That's how much you're willing to risk initially. We got a little pullback after you entered, and then the trend resumed. So your actual risk is from your entry price here to just below the low of this bar right there. Bull trend, high probability trade. This is 1 times actual risk, and that's a reasonable target for scalpers as long as it's at least as big as a minimum scalp. 1 times initial risk is a little bit higher. The initial risk is greater than the actual risk, and the market went a little bit above that projection, although it's hard to see on this screen. It went a little bit above, so the traders who tried to exit at 1 times actual risk made their target. Their profit taking, in part, resulted in this pullback. Remember what you're trying to accomplish here. You're trying to make money. And to make money, you need to be trading in a way that results in a positive trader's equation. If you take 100 trades, you want to make sure that the trades you take result in a profit at the end of those 100 trades. You lose some, you win some, but you want a profit. There are only 2 things that you can control. Risk, which is where your stop is, and reward, which is where your profit-taking limit order is. And you have to be able to take profits that make sense mathematically. It's always mathematically acceptable to take profits at 2 times actual risk. When it's small, you can go for a bigger target, for example, 2 times initial risk. If you're buying in a trend, taking profits at 1 times actual risk or 1 times initial risk makes sense because the probability of making money is higher. If you go for a tighter target, a smaller target like 1 times actual risk, you have a higher probability of success, which makes sense because your reward is smaller. If you go for a bigger target, like one based upon initial risk, the target's further away, the reward is greater, the probability is slightly less that you will achieve that goal, but the math is still valid. We have a bull trend. Let's say you bought the follow-through bar, the close of this bar after this breakout above that high. Mathematically, that is an okay thing to do. And let's say you put your stop just below the low of this bar, and you would have been stopped out here. This low fell below the low of that bar. That would have been your initial risk. You buy here, you put your stop just below this bar, and the market fell just below the low, you would have been stopped out. Let's say instead of the bulls getting stopped out, the market went up 5 ticks or 11 pips without pulling back. That trader then could have scalped, theoretically at least, with a 4-tick profit, or if it was a Forex market, a 10-pip profit. That would be greater than the 2-tick or 5-pip actual risk and equal to the 4-tick, 10-pip minimum scalp size, resulting in a positive trader's equation. But instead of reaching that minimum scalp, 4 ticks above the entry price, or Forex market 10 pips above the entry price, the market fell maybe 20 ticks or 50 pips to below the stop, and the trader ended up losing 20 ticks, for example, if it's an E-mini or a stock, or 50 pips, let's say, if it's a Forex market. Can a trader keep going for a 4-tick scalp or a 10-pip scalp and sometimes lose 20 ticks, sometimes lose 50 pips, and still make a profit? Here we have a bull breakout, and we have bull bars with bad follow-through. Bull bar, doji bar, bull bar tail, doji bar, bull bar, bar with a tail, doji bar. Traders would conclude that the market's probably evolving into a trading range with these two dojis, spike, pullback, channel, and the start of a trading range. Therefore, the premise has changed. If you're buying up here on the premise that it's a bull trend, and you see all of this trading range price action, you probably have to conclude that it's in a trading range. It's still in the bull trend, but a trading range within the bull trend. You can also argue expanding triangle, a little reversal down, reversal down, reversal down. If you took that buy, should you wait for your stop to be hit below the low of this bar? A lot of traders would just say, okay, it's really not a strong bull trend at this point. It might be a trading range. I could get a very deep pullback. Maybe I should just exit below a bear bar and get out here instead of waiting for my stop to get hit down here. And if you did exit there, we have a strong bear bar, probably at least a small second leg sideways to down. And this could be that second leg down. We have a bull bar closing on its high, another bull bar closing on its high here. This is a second reversal up from around this low, the bottom of a developing range. It's a reasonable buy. Now let's go back to the trader who bought this close, hoping that the market would continue higher. And let's say he put a stop below the low of this bull leg. This is really not a particularly major higher low. We got a new high, but the breakout is not all that strong. It's probably better to think this might be a trading range and use a wider stop, maybe below here. But let's say he did put his stop below that bar. He lost a lot of points. So he was trying to make 1 point and he lost several points. Or if he's trying to make 10 pips, he lost whatever, 50 pips. This is not representative of all of his losing trades. It's an outlier. It's unusual that he'll be losing that much when trying to make a scalp. Also, it's not great trade selection. Not many bulls would take the third push up after a breakout. Breakout, second push, third push, especially when the rally looks weak and there's a potential for an expanding triangle top. Therefore, this is not a typical average buy, and this is not a typical average risk that you would be taking, and therefore it doesn't represent accurately what an average trade looks like. If you're scalping, therefore, you should not look at this and say, well, how can I possibly make money if I'm risking several points to make 1 point or 50 pips to make 10 pips? It's because this is not what the average losing trade looks like, and this is not what the average entry looks like. So it's not representative of an average collection of trades that you would take. For every one of those 20 tick or 50 pip losses, there is an equal number of double bottoms and 20 tick or 50 pip gains. Here we have an example of a bull breakout and good follow through. Traders can buy that close. And probably better to put the stop below the bottom of the bull trend, not just below the bull breakout. And the market came exactly down to the bottom of that bull trend, and twice it got there, micro double bottom, and did not hit the stop. And now your actual risk is just below this low. You bought here, the market went against you to just below that low. It's reasonable to go for a profit at least 1 times actual risk, which is up here. This is an extreme example the other way. There was an extreme drawdown, the stop did not get hit, and the trader was able to hold for a reward bigger than 4 ticks or 10 pips. It also is an outlier. It's something unusual, not representative of a collection of trades that you would take. But these trades do happen. Just like you get occasional big losers, you get occasional big winners. Again, not a strong buy setup. Most of the setups have higher probability and smaller risk, but if you take this trade, your stop is below the bottom of the major higher low, below this low. And if you get a deep pullback, then your actual risk is big, and it's probably worth trying to make a profit that is equal to your actual risk. A lot of traders would simply get out break even at their original entry price, and that's what caused this pullback. Some traders would buy here, keep the stop here, and then when they get a bull bar, they'll buy more here, and either get out everything here or part out here, and then the rest here. Whenever you're looking at a strategy and trying to determine if it makes sense mathematically, you have to be careful about sampling error. You can't just sample one setup and assume it represents all the other setups, because a lot of times you'll be picking one that's fairly extreme and not representative of all the other trades that you take. If you take 100 trades and go for 1 times risk when the trades are high probability and 2 times risk when the trades are low probability, the odds of making a profit are very high. If instead you only want to look at a few of your 100 trades and try to determine whether or not your strategy is good, make sure that the sample that you're looking at represents an average typical trade and not an extreme winner or an extreme loser. If 1 billion people each took 100 trades and managed them well, the group has a very, very high probability of making a profit. However, there'll be one person in that group of 1 billion who loses 20 ticks or 50 pips on all 100 trades. That's sampling error. There'll also be one lucky trader who makes 20 ticks and 50 pips on all 100 trades. Again, those are the outliers. But the entire group would make money, which means the average person who used that strategy would make money. I made the point that if you base your profit on the size of actual risk, you have a reasonable approach to trading. Your minimum goal is going to be at least 2 times actual risk for most trades. If you're buying a high probability trade or selling a high probability trade, for example, during a strong breakout, you can exit with 1 times actual risk. But that is the minimum, and the minimum is rarely the best. And I talked about other ways to use risk to find your profit targets. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 2 videos on actual risk. This is Al Brooks. Thank you for watching the Brooks Trading course. This is the first of 2 videos on scaling into a trade. I'll begin by talking about who scales in and why they scale in. Next, I'll move on and talk about scaling into a winning trade. I'm going to use this slide to illustrate scaling in to a winning or a losing trade. We have a bull trend and then a bear channel, which is also a bear trend. Scaling in is a technique that traders should consider using after they have some experience trading, and preferably after they've become consistently profitable. It's difficult for beginners. It's tempting because they understand that it can increase the probability of success, but whenever you increase your probability of success, you additionally increase your risk. Also, there are added decisions that you have to make, and sometimes you have to make them quickly. And one of the common mistakes that beginners make is they don't know when to get out, or they refuse to get out. Their losses start to grow. They no longer are objective. They manage their trades incorrectly, and then they end up losing much more money than they ever expected. However, strong trends do offer great opportunities for traders to scale in, add on to their position as the trade continues. For example, at the beginning here, we have 5 consecutive bull bars, and then we have a little pullback, and then we have a breakout. So it's a strong bull breakout. It's reasonable to buy here, and your stop goes below the bottom of the bull trend down here. And if you're still long at this point, we have another breakout, another bull flag, 3-bar pullback, but then we have a bull bar. So it looks like the trend is resuming. You can buy on a stop just above the high of that signal bar. So now you have a bigger position. Every time there's a strong breakout, especially to a new high, traders raise their stop to just below the low of that new leg up. One of the most important things when scaling into a trade is trading the appropriate size, and it's often much smaller than you think. And I call it the I don't care size. You have to trade so small that you really do not care. You need to remain objective, and you can only remain objective as long as you're not thinking about money, and instead you're thinking about the trade. Am I doing what is right based upon the charts, not based upon a growing loss in my account, or not based upon my risk increasing because of my increased position size? Traders starting out often cannot remain objective, and therefore scaling in is emotionally too difficult for them, and they need to wait. Every trade eventually ends. Every trend eventually ends. Here we have a micro channel lasting about 8 or 9 bars. That's a breakout on a higher time frame. Here's another breakout, even stronger. And then look at this. We have an even stronger breakout. So we have consecutive buy climaxes there, a bigger one here, and an even bigger one here. This one is the biggest one occurring after 20 bars in a trend. Whenever that happens, it's more likely that it is the final leg of the trend, or near the final leg of the trend, and the trend is about to reverse. A breakout that strong often has one more push up before it tries to reverse. Selling a first reversal down, especially below a bull bar, or at the bottom of a tight trading range, is usually not a high probability trade. However, after the market has 1, 2, 3, 4 bear bars, 3 of them closing on their lows and having a decent sized body, then we have a big up, big down, big confusion setup. Probably the best the bulls will get over the next 10 or 20 bars is a trading range rather than a resumption of the bull trend. Because of that, bears are starting to sell. For example, they'll maybe sell this close. And because it might be a trading range, they have to put their stop above the high. It may also be a bear trend. On a higher time frame chart, this 5-bar bear channel is probably a breakout, so we might get a spike, pullback, and channel, which we did. Traders will sell. Some traders will sell the close of that fourth consecutive bear bar. Some will sell the close of that third or even the second when the two bars are as big as they are in closing near their lows. This bar closed below the low of the past 6 or 7 bars. And we have a wedge. You can call it a wedge. 1, 2, 3. Also, very strong bull breakout. Strong enough for a second leg up. That's the second leg up. And it is not strong, so traders are expecting a reversal. Strong enough leg down, bears will put their stop above the top of the bear leg. Whenever there's a strong trend that has consecutive buy climaxes or a wedge, 1, 2, 3, traders are expecting 2 legs down. 1, and then pullback, and then 2. Some traders will wait for a bear bar like this, a weak rally, 2 legs up, 1 pullback, 2, and they'll sell below the bear bar, or maybe they'll sell here, a wedge, 1, 2, 3. So a small wedge, lower, high, major trend reversal. Bull trend, strong bear breakout, weak rally, testing the prior high. So traders are looking for a second leg down, and they'll sell below there. So they sold here, they're losing money, and they add to their losing position. But when they're selling here, they knew their stop was up here, and they knew they may want to sell more higher. So they traded small enough so that this position plus this position would not create too much risk using a stop up here. When they sell higher, their average entry price now is in between the two. So their average entry price is right here. Whenever you add to a losing position, you're only doing it if your premise is still valid. It increases your probability, but whenever you get high probability, you have to pay for it. And the other side of probability is risk-reward. If you're going to create high probability, you're going to pay for it with worse risk-reward, and usually with greater risk. So you're doubling your position size, so you're increasing your risk. Some traders, when they're increasing their position size and it's a losing position, they've given up their hope of making a profit. Instead, they've changed their goal. Instead of hoping for a profit, they're simply trying to reduce or eliminate their risk. So, for example, let's say an optimistic bull did not think about this as being a likely exhaustion bar, and instead he saw a pullback 1, so a high 1, and then a high 2, a small double bottom, and he bought above that bar. And then he starts to see this, and he's saying, oh my gosh, it's not good, it's pulling back. But after a strong bull trend, the first reversal down usually results in a trading range and not a bear trend. Maybe it's safe to buy more lower. That's his stop at the bottom of the most recent bull breakout. Now he has a strong bear reversal. And he knows when a reversal is that strong, the market probably will have a second leg down. He also sees the consecutive buy climaxes and the wedge, 3 pushes up, 1, 2, 3. So he expects 2 legs down after such a strong bear reversal. However, he also knows that it was reasonable taking this buy. Usually if you do something that's reasonable and then you manage your trade properly, usually by scaling in using appropriate stops, you can either make a profit or avoid a loss. So what a bull might do is buy here, sit through the bear trend, it's around a 50% pullback, and he waits for a bull bar, and then he buys above that bull bar, or he might say, 5 bear bars, maybe I'll better wait for a second entry buy, so maybe he'll buy above this bar or that bar. However, his goal at this point is not to make a profit. He believes that the market's going to have a lower high and a second leg down. But he also believes doing this was rational, and buying above a bull bar is rational, so the market will probably let him out break even. He's buying here, hoping to exit exactly at the midpoint of his 2 entries, here and here. That's his first entry, just a little bit above that bar. His second entry is a little bit above this bar, and the average entry price is right here. He might place a limit order to get out at that average entry price. If it's not filled, and then we get a micro double top, up, pullback, up, he'll then get out below the low of that bar. By taking the second entry, he either eliminates his risk if he got filled there, or he reduces his loss. So he eliminates his loss, gets out break even on his trade here if he gets filled. If he does not, he'll get out here, and he'll still have a loss, but it will be a much smaller loss because he scaled in here. The bears are thinking the same thing. Wedge top, strong bear reversal, 2 legs down, so they're looking to sell a lower high. So they'll sell exactly where the bulls are getting out. We have a micro double top, 4 or 5 bars up, a reasonable sell, and it's a 50% pullback. I talked about 50% pullbacks in my other videos. At 50%, the risk for the bears is here, and minimum reward is here, about the same. And for the bulls, their risk is here, their reward is here. But in this particular situation, the odds are we're going to have a second leg down. Yes, the risk and reward is equal for the bulls and for the bears, but the bears have higher probability, so it's a reasonable short. The bears will sell a 50% pullback, either with a limit order or on the reversal down. Whenever traders scale in, they have to have a plan. How many times are they going to add to their position? And what intervals? How far apart will their entries be? What size? And then they also have to know when they plan to exit, and if they're planning to exit with a profit or a loss or a break even. I talked about adding to a winning position in a strong trend, buying here, stop here, and then buying more higher. New stop. And I talked about adding to a position where you're probably going to lose money and you're trying to avoid a loss. I also talked about adding to a losing position. Bears selling here, expecting that it's such a strong reversal after a wedge, the market's going lower, probably at least to the bottom of the buy climax, and it probably will have 2 legs down. It may just go straight down. It may bounce first. But in either case, the bears know the probability is they're going to make a profit. They sell here, thinking that, okay, I'll put a stop up here, but I'll trade small enough so that if in fact we enter a trading range, I can sell more higher and then either avoid a loss or make a profit. The bear sells here. He has a losing position at this point. He sells more here, stop up here, and he trades small enough so that if that stop gets hit, his entire position will not result in a loss any bigger than he would get on any other trade. And if he held for a swing, he ended up making a nice profit. Now, who scales in? Professional traders do it all the time. For example, a fund manager, like billionaire Carl Icahn, Warren Buffett for that matter, might be scaling into positions. As he's trying to take over a company, he may increase his stake even as the company loses money and loses value. Here's an example with Carl Icahn. In December of 2015, CNBC reported that Icahn added to his losing position in LNG for the 8th time, even though it had fallen more than 50%. It kept falling and falling and falling, but he believed it was undervalued and that it would reverse up. He added to his losing position 8 times, but each addition did not increase his position size to an uncomfortable level. He was able to remain objective. Individual investors also scale in. If you ever watch Kramer on Fast Money, he'll sometimes tell you, buy part of your position now, and then wait a few days and buy part more. And then you also hear about averaging down, or dollar cost averaging, which is a very common, sensible approach to investing for individual investors, like buy 1/10 of your position this month, and then no matter what the stock or market is doing, buy 1/10 more next month, and you do it for 10 months. And that is scaling in. You might be scaling into a winning position, you might be scaling into a losing position, but dollar cost averaging is a common, sensible way for long-term individual investors to enter the market. And then another group of traders who scale in regularly are short-term traders, traders holding positions for a few days, a few weeks, and day traders. Here we have a pretty strong rally, a very tight bull channel. Probably the first reversal down will be limited. Stop down here. If this is a bull trend, it should not fall below the bottom of the most recent strong bull breakout. Some traders might buy here with the intention of putting a stop below here, and if it pulls back, they'll buy more. One way to do it is you could buy with a limit order below that bear bar, betting will not fall below here, or they'll simply buy more 10% lower, or a certain number of ticks or pips lower. Or they'll also buy on the reversal up. We have an II bull flag after a strong reversal up from a higher low. I mentioned dollar cost averaging. Investment advisors often tell their individual clients, do not buy the entire position at one time. Instead, divide your entire account up into pieces, like for example 10 pieces or 12 pieces, and then you buy each piece every month or so until you have your full position. For example, if this were a stock, let's say it's XYZ stock, and you wanted to buy 10,000 units of the stock or 10,000 units of a Forex position, and you're planning to hold for a number of years, 5 years, instead of buying all 10,000 units or shares or contracts all at once, you might go ahead and buy right when you make your decision. So let's say sometime in here you're deciding, yeah, I really want to own this and I want to hold it for a long time, but I don't want to buy the full 10,000 units right now because suppose it just keeps falling all the way down here. Then let's say it falls 20%, then it has to go back up 20% for me just to get break even. So maybe I'll just buy part of my position. If it goes up higher, I'll buy part more higher. I'll buy part more higher. And instead, if it goes down, I can add to my position, relying on my stop here or here. As long as my premise is still valid that I think it's going to go up, I'll be comfortable adding to my position. So let's say he started buying right here, and then he bought another 1,000 here, 1,000 here, 1,000 here, 1,000 here. All the way, every month he bought 1,000. And here at 10 months, this would be his average entry price. Even though he started buying here, his average price now is here. And that's including after a sell-off. Now he's got a sell-off and a reversal. And he has a reasonable entry price now that we have that reversal. And the advantage to the trader is he avoids the uncertainty possibly buying too high. So he increases his probability of profit because he's getting an average entry price, a price between the high and the low over the next year, instead of possibly buying the high over the next year and hoping for it to go higher. This is a common situation. Here we have a bull microchannel, 6, 7, 8 bars, and a beginner will look at that and say, yeah, it's going up. And he believes it'll continue to go up as long as it stays above the bottom of the most recent strong last leg up. So let's say he buys for any reason. The 6th close, buys below that low, buys above this high, buys a bear bar betting that the first reversal down will fail. His stop goes down here. If he's looking to buy up here and the stop is too far away, he can wait to buy where a scale-in trader might add to a position and still use that correct stop. For example, he might say, well, I don't want to buy up here. The risk is too great. I'll buy a pullback, maybe a 50% pullback. So then my risk would be half of what it would be had I bought up here. That's okay. The only problem is sometimes you don't get the pullback. So let's say right here you're planning on buying, looking for a 50% pullback. You don't get any pullback until all the way up here, which is a much worse price had you bought right here. He waits for his 50% pullback, and now he sees a pretty good reversal from a higher low, strong reversal bar, down, up, good reversal, II with a bull bar, and he can add to his position here after a micro double bottom, down, up,
down, up. Micro double bottom with a strong reversal up. Day traders, short-term traders, they'll scale into losing trades to increase their probability of profit and reduce their chance of a loss. Again, whenever you try to increase your probability, you have to pay for it. Anytime you're going to get something good, you have to pay for it. Nothing is free. And usually, when you increase your probability, you're going to increase your risk. You're certainly going to reduce your risk-reward ratio. Usually greater risk and sometimes less reward. So let's say a trader buys expecting a continued rally, even if there is a deep pullback, as long as the pullback remains above the bottom of the most recent bull breakout. So that's his premise, that it's a bull trend as long as there's not a credible top. This is not a credible top. And as long as any pullback, no matter how strong, remains above the bottom of the bull leg. He might buy here. He might buy the second consecutive strong bear close, saying we got a bear breakout below these bars. We have a follow-through bar. Some bears will think this is always in short. But as long as it remains above this low, I'm going to bet that this breakout will fail and that it's a bear trap, trapping bears into selling this close, selling what might turn out to be the bottom of a pullback in a bull trend. He might buy that close, knowing that weak bears will sell the close, hoping to break below here, but he still believes this trend is so strong, any reversal attempt, even a strong one, consecutive bear bars closing on its low, will fail, so he'll buy more lower. If he's sufficiently disappointed by the strength of this bear reversal, he might decide, okay, maybe we're going to go sideways instead of up. Here's my first entry price, here's my second entry price, here's my average entry price. I'll place a limit order to get out break even. So if he buys here and immediately places a limit order at the midpoint of his two entries, he might get out here. In that case, he would be averaging into his trade to avoid a loss and not so much to make a profit. However, he could hold and he would end up with a very nice profit. Another alternative is you could buy that, buy more here, and then try to make a profit on his second entry and get out break even on his first. So he buys here and immediately places a limit order to exit the entire position at his first entry. So he gets out break even on this trade and then with a profit on this trade. That's another common approach that traders use. Now I'm going to talk about scaling into a winning trade. Strong bull trend. A bull might buy a pullback, an attempt at a reversal, but then the reversal looks like it's going to fail. The bull might buy the resumption up from the pullback, so the breakout above the pullback bar. Stop, obviously, at the bottom of the bull breakout. And he might add to his longs as the market continues to rally. He could buy for any reason, but he wants the space between each of his entries to be at least as big as a minimum scalp. So he doesn't want to buy and then buy later at the same price. If he's going to be buying as the market's going up, he wants the second entry to be at least the size of a scalp more than the first entry. And he has to keep calculating his total risk based upon the position size and his stop. And he has to make sure that his risk remains within his comfort zone. Another bull flag, another bull breakout above the bull flag, buy more. We have a bull breakout to a new high, put the stop below that new bull breakout, which is above his first entry price. So now he's entered twice. His position is twice as big as it was initially, and his stop now is around his first entry. Another bull flag, a high two bull flag, two small legs down, one pullback two, and then we have a bull bar. Maybe he'll buy more on the resumption up. Here, this looks like we're getting small bars, doji bars. We might be forming a tight trading range, so his premise might change. At this point, he might be thinking, well, maybe I'm buying a bull channel instead of a bull breakout. Maybe I'll start using a tighter stop, especially if the position is getting big. If his premise is still valid, that it's now a bull channel instead of a bull breakout, it still should form higher lows. So this low should stay above that low. So he could use a tight stop, especially if he's then adding on and now has a large position. Very strong bull breakout. Traders have to be very quick to reduce their position size to a normal position size if the breakout is no longer a strong bull breakout, if it starts to convert into something else like a bull channel or a trading range. An experienced trader will be very good at detecting a loss of momentum and a possible transition into a channel or a trading range. If at any point their premise is no longer valid, they'll exit their entire position. So if they buy here and buy more here and buy more here, they're buying it on the premise that perhaps it's a breakout that may continue up much higher before it transitions into a channel. However, if the market does something to make them question that premise that the breakout will continue a long time, they'll be quick to get out. Here we got one push up, two pushes up, possibly three pushes up to a parabolic wedge top, and we might reverse at that point. We got a doji here, a small bar here, a doji here. That's looking different from this, where we had consecutive bull bars, consecutive bull bars, consecutive bull bars. The market's starting to look different. We have a possible buy climax and a tail and a doji, a small bull bar, and then a doji bar, and then a possible parabolic wedge. 1, 2, maybe we'll just go up a little bit and form 3, and then start to reverse down. When traders see that, they're thinking that maybe the market is transitioning from a strong bull breakout phase into either a trading range or a channel. Again, look at the character of the bars. A bear bar now. We have not had a bear bar since here. Small bar. This bar is below that bar. Here we have been pulling back for 5 or 6 bars. A breakout with shrinking bodies, and then a doji, small doji, doji, small bar. So these bars over the past 10 bars are different from these bars. So the premise of a strong breakout has changed. This is no longer a strong bull breakout. It's a bull channel, but it might also be a trading range. We could easily trade back down here. When you start to see smaller bars, overlapping bars, the channel, the slope of this is not as steeply up as is this. You're getting tight trading range price action here, here, here. In fact, the entire thing might be part of a big tight trading range. So at that point, now we have a wedge, possibly wedge, higher high, major trend reversal, bull trend, small breakout wedge. It's still a small pullback bull trend at this point, but it's no longer a breakout. A trader might want to reduce his position back down to a normal position size at this point. Had he bought here and then added here, so a double position, and then added here, so a triple position, at this point he may cut back down to a normal size position. Or he may exit entirely. If he exited entirely, look at what happened over the next 30 or 40 bars. No profit. Exiting entirely would make sense. Here we have a very strong bear trend. It's a sell to close bear trend. Well, at this point or that point, it's a sell to close bear trend. Traders are selling. They'll sell that close, this close, this close. They'll sell the bull close. They'll sell that close, this close, this close. Here are examples of possible entries. They can add on. They can just they take a position here, sell more here, sell more here. You're not going to sell more here if you sell here because this is not at least a scalp size below this. A lot of traders will take one of these trades, maybe one or two. A lot of traders will take one, scalp out, and then take the next one. But let's say you're adding to your position and you take 2 or 3 of those. Then fine. You got to be trading small enough so that a stop up here will not create so much risk that you will not manage your trade properly, and so much risk that you have a greater risk than you have on any other trade. And most traders cannot think fast enough to sell more, sell more, sell more. And they should only take one of these entries, doesn't matter which one, any one, and then use the appropriate stop, and then just hold for a swing until there's a pretty strong reversal up, and then get out down here. Some traders will sell here or here, and then see these additional entries instead of adding them to their swing position, they might scalp. So you sell here, here's another sell, I'll sell this one for a scalp. Here's another sell, I'll sell this one for a scalp. Another sell, I'll sell for a scalp. So they hold their initial swing entry, and then they scalp additional entries. And then other traders, as I said, some experts, will just keep adding to their position until they believe their premise is no longer valid. Low 1, low 2. So a low 1 or a low 2 bear flag. Here we have a pause bar. We went above it, so this is a pullback, and that makes this a low 1 sell signal bar. So some traders will sell below the low of that bar on the reversal down. There are many ways to sell in a bear trend. As I said earlier, if you're scaling into a winning trade, you want the next entry to be at least a scalp below the first one. So if a scalp in the E-mini is 1 point, you don't want to be selling again unless you're 1 point lower. Consecutive sell climaxes, climax, big trend bar, so a climax, big trend bar, so a climax. So if you were scaling in and you see consecutive sell climaxes, you know there's a risk of a pullback or maybe even a trading range. It's a good time to reduce your position or possibly even get out entirely and then wait for another sell signal before selling again. We had a strong breakout and then we got consecutive sell climaxes, so the premise of a strong breakout is no longer valid. Look at this. The strongest pair of bear bars occurring 20 bars into a trend. You have to be thinking about the possibility of an exhaustion gap, a final sell climax, and the end of the trend. So whenever you see the strongest pair of bear bars occurring late in a trend, you have to be thinking that 75% chance the gap between this close and this low will probably close. It's probably an exhaustion gap, not a measuring gap for a measured move down. So that is a good reason for bears to exit. Smart bears will buy back their shorts here. It's no longer sell the close. We have consecutive sell climaxes, 1, 2, 3, 4, 5, and then 6, and we have a huge sell climax very late, 20 or more bars into the trend. The bears know it's probably not going to go much further, and in fact, we'll probably get a couple legs sideways to up. So a smart bear would buy back his shorts here, and a smart bull, an aggressive bull, would buy here. Other bulls will wait to buy the reversal up, but they could buy here and then put a stop down here, maybe based upon a measured move down from here, thinking that strong enough maybe we get a small second leg down. But if we do get a second leg down, we'll probably then reverse. Either reverse here, or maybe we get one more small leg down and then we reverse. If you're adding to a losing position, you only want to add to your position if you believe that your original position is still valid. So let's say you look at this and say, it's a buy the close bull trend. It's not all that strong. We have tails, we have bear bars, tails. This looks like a bull trend and what will end up as a trading range, but it may go up much higher before it begins the trading range. It's okay to buy here if you're willing to put a stop all the way down below the bottom of the bull leg. Putting it down below the bottom of the buy climax is not good, because if this is a bull leg and what will become a trading range, it usually will fall below the bottom of the final buy climax. Trader buying up here, he knows he's buying in a weak rally. That's probably a bull leg and what will become a trading range. He sees the wedge top. He could buy hoping that we go up a little bit further and he can make a profit, or he can buy knowing that we may pull back deeply, because if it's a trading range, we can get a very deep pullback. However, if it's a broad bull channel, the deep pullback should stay above the bottom of the most recent leg up. A trader buying up here only buys up here if he's going to put a stop down here. Strong bear reversal. It's possible that his premise is no longer valid, that we're not in a broad bull channel or any kind of a bull trend. Instead, we could be in a trading range or in a bear swing. Most traders, they got a bear breakout, a pullback, and now we have a low 2 short, low 1, low 2. Most traders should get out either on that close, above this bar, below that bar, below this bar, and then just wait But some traders will hold and put their stop down here and then look to buy a reversal up lower. Just like the rally had problems, it was weak. Look at the sell-off. A big bear bar, but a disappointing follow-through bar, and then a doji bar. Doji, doji, small bar, doji, doji. Just like this looked like a bull leg in what would become a trading range, this looks like a bear leg in a trading range and not the start of a strong bear trend. A bull who bought here might hold long, stop down here. Some traders don't like to be getting in, getting out, getting in, getting out. They just buy and hold as long as their premise is still valid, and they use an appropriate stop, which is often very wide. A scale-in bull who bought here with the intention of scaling in lower, as long as his premise was valid. He buys here with a stop down here, but he's buying small enough so that he can buy again on a reversal up above a bull bar, or above here, a double bottom higher low. So he buys here and then buys more here or here, stop here, but he makes sure that he's trading small enough so that his combined position does not create more risk than any other trade. So he bought here and he bought more here or here, stop down here. As I said earlier, these scale-in bulls often exit the entire position back at their original entry. So they get out break even on the first entry and then with a profit on their second entry, whichever two it was. However, a bull who buys here and he places his limit order to get out of his entire position here, break even on the first, profit on the second, and then he sees this, it starts to become a buy the close bull trend. He might decide to only exit half of his position here because this is such a strong bull breakout, we're probably going higher. Biggest bull bar in a rally that's lasted more than 20 bars, probably an exhaustion gap. So the gap between this close and this high probably will close. So we'll probably reverse down below that high. And then we have a bear bar here and a parabolic wedge. We're having a bull breakout above a bull channel, probably going to fail and go at least sideways to down. So at this point, the premise is no longer valid that the bull trend is still in effect. Most traders, if they bought for any reason, should be getting out of longs here because bears will be selling there looking for at least 2 legs down.
In this video, I talked about traders who do scale in, and that includes everyday individuals trading their own account at home when they do dollar cost averaging. Next, I moved on and talked about scaling into winning trades. This is Al Brooks. Thank you for watching the Brooks Trading course. This is the end of video 35A, Scaling In. It's the first of 2 videos on scaling in. This is Al Brooks. Thank you for watching the Brooks Trading course. This is a video on how to scale into trades. It's the second of 3 videos. In this video, I'm going to be talking about scaling into a losing position. So if you take an entry and the market goes against you, you can add to your position under certain circumstances if you manage the trade correctly. When a person puts on a trade and it becomes a losing trade, a lot of times traders will scale in not so much to make a profit, but to avoid a loss. And there are many ways to do it. You can buy at a fixed interval down and multiples of that. For example, in the E-mini, if a scalp size is 1 point, you might buy more. Let's say you buy high and the market starts to go against you. You can buy more 1 times a scalp size. In other words, 1 point down, 2 points down, 3 points down. If you're trading a Forex market, you could buy a multiple of the minimum scalp size there, which is 10 pips. You buy more, 10 pips lower, 20 pips lower. Other traders buy once. Let's say you take the absolute worst buy and you buy up here. And you're confident that your premise is good, that the market will go higher before it falls to the bottom of the major higher low. Then some traders, instead of buying at a fixed interval down, will buy at a percentage. And the most popular percentage is 50%. The strong bull breakout began here. This is a major higher low. It led to a strong rally and a new high. So if the bull trend is intact, then any pullback, no matter how deep, should stay above that higher low. Traders put their stop there, and as long as it stays above there, they're willing to hold on to their position and even add on, for example, as the market's turning up again. You have a bull trend here and a pullback, and you could buy anywhere. And let's say you happen to buy the worst price. Let's say you buy the close of this small bull doji bar. Now, bad follow through, next bar, and then a reversal down here. A lot of traders would look at that and say, well, strong enough, big up, big down, big confusion. Maybe we'll fall for a couple legs down. Maybe I'll just get out and I'll wait to buy when it reverses back up. And that is an okay approach. So you do an early exit and don't wait for your stop to hit. And then other traders will look at it and say, yeah, I know I bought high, but it could have kept going up. And the momentum up is strong enough so that even if it sells off, I'm pretty confident that it's going to get back to that price. So if I add on somewhere, like on a reversal up, maybe above a bull bar like that, or above this, or above that, and then it gets back to my original entry price, I get out of my first buy, break even, and then with a profit on my lower buy. And if the reversal up is strong enough, I'll hold the entire position until the market starts to reverse down, and then I'll make a profit on my first buy and my second buy, wherever my second buy is, here, here, or here. So let's say you buy that close. You buy the close, and it turned out to be the highest close right before a reversal. And let's say you decide that as long as it stays above this low, the premise is valid that it will get back to that close at some point. And you're willing to scale in lower. Most traders will scale into a losing position only 1 or 2 times. Some traders will scale in many times, but most traders will only look for a single or a double entry. For example, you could buy over here, or you could wait for 2 legs down, 1 pullback 2, a 2-bar reversal and a higher low, or now we have a double bottom higher low, and you could buy above that bull bar or above this bull bar. So if you buy here, here are 2 options. Most traders would take one, but not both. Also, most traders do not want to hold through a pullback this deep. However, it is okay. The math is okay. As long as we're holding above this low and the reversals down do not have a lot of follow through, chances are this sell-off is a bear leg in a trading range or simply a bull flag. And in either way, it should get back up to that price. Every trader should go into every trade with a plan. And as long as the initial premise is still valid, they can hold on to their position. But if the market is behaving in a way that's not consistent with their position, they should exit. So if your plan is failing, you get out. Now, if you buy high and the market immediately reverses down, your minimum goal is to avoid a loss. And to avoid a loss, if you buy here and you buy more, let's say here, and you get out in between the 2 entries, you avoid a loss. You'll lose a certain amount on the first entry, and you'll make the exact same amount on the second entry. So that is the minimum goal, and some traders do that. Most traders, when they're scaling in, are not trying to avoid a loss. At a minimum, they're trying to get out break even on their first entry, and then with a profit on their second entry, their lower entry. In general, you want to make at least a minimum scalp on your second entry, and that means your second entry has to be at least a minimum scalp below your first. So if you're trading a stock and your minimum scalp for a stock is 10 cents, then this entry has to be at least 10 cents below that. If you're trading the E-mini and the minimum scalp is a point, then these entries, whichever one you take, has to be at least a point below that. If you're trading in the Forex market and the minimum scalp is 10 pips, then this has to be at least 10 pips below that. Otherwise, you don't take the trade. You just wait and you hold on to that original position. I said the minimum that a scale-in trader wants is 1 times the minimum scalp. Ideally, you want your second position to be 2 or 3 times greater than the minimum scalp. So in a Forex market, if you're buying here, you'd rather be buying 30 pips lower here, not just 10 pips lower. E-mini, you'd rather be buying 3 or 4 points lower, not just 1 point lower. A lot of traders are comfortable, even with this bad entry. They did not know it was going to be a bad entry. It turned out to be a bad entry, but a lot of traders are comfortable just relying on their stop. They don't worry about getting the best entry. They just want to take any entry that makes sense. and buying anytime in a bull trend makes sense. So you just put your stop below the most recent major high or low, the bottom of this bull breakout, and trust that the market will not quite get there. If your stop is far away and you're planning to add on lower, in general, you want your initial position to be no more than a third, maybe a half of the maximum acceptable risk. I'll talk about specifics, but let's say you normally risk 6 points in the E-mini, right? And let's say this is 6 points below. You could trade one contract and not scale in, but if you're thinking about scaling in anywhere through here, this position should be maybe a third to a half of your normal position size. So if you normally trade 10 contracts, this should be 3, 4, or 5 contracts, allowing you to add on lower. For example, let's say the stop here is 50 ticks below the entry price. It could be $50 if it's a stock. It could be 50 pips if it's a Forex market. But let's just say, for the sake of argument, in this particular example, let's say you buy here and your stop is right below here, and that's 50 ticks below. Let's say you do not like to risk more than 20 ticks on any trade that you typically take. That means that if you're now risking 50 ticks and you normally only want to risk 20 ticks, then you have to be trading maybe a 25 to a 50% normal position size. So if you normally trade 10 contracts in the E-mini, I know most traders do not do that, but if they did, and they're now risking 2.5 times normal, they should only trade 2 or 3 contracts if they buy up here and put their stop down here. You have to adjust your position size based upon your risk. Well, let's say the bull bought 1 unit up here at the close of the follow-through bar. You got a bull breakout bar, you have a bull follow-through bar, and stop goes down here. So he buys up there and he puts his stop down there, below the bottom of the major high or low. He could put it down here as well, the beginning of the bull trend. Both are acceptable. If that trader bought here and he's thinking about adding on, he wants his next entry to be at least 1 to 2 times the size of an average scalp. So if an average scalp in the E-mini, the average minimum scalp is 1 point, then the bull would prefer to put his second position on, his second part on 2, 3, or 4 points below his first. In general, he also wants the second position to be at least a third of the way down to his stop. So he might look at this and say 2 legs down, 1 pullback 2, maybe buy above this bull bar, and that is acceptable. The problem with that is the channel down at that point is very tight, so chances are there'll be at least one more leg down. But it is okay to buy here and then buy more above that bull bar, hoping that it's the end of the correction. And if he was willing to scale in a second time, he would look to buy at least 1 point below that, 1 point the minimum scalp, and he'd like to buy above a bull bar, so either there or above here or above there. And if he's very aggressive, let's say he bought 1 part here, second part there, a third part there, he might even buy more here, but this is essentially the same price as that. You're increasing your position, but you're not buying at a lower price. Most traders would not do that. If you start to see a strong reversal up, the bar is getting bigger, closes on the high, you could hold your position until there's a possible reversal of the trend. Here we got a buy climax and a bear bar and a failed breakout. So some traders would buy here, let's say the trader bought here and bought more here. So he bought 3 parts, he would get out below that bear bar after the buy climax and the failed breakout above this high. A lot of traders, they buy here, and let's say they buy here, they're just trying to get out, break even at their first entry. And that's because they look at this and say, okay, bull trend, the selling is too much, the pullback is too deep, probably now, instead of a bull trend, it's a trading range. And if it's a trading range, it might not get much above this current high of the trading range. And therefore, if I buy here and now conclude the market's in a trading range, I want to sell high at the top of the range, maybe at that close, so I get out, break even on my first trade, and then with a profit on my second trade. If the premise is still valid, the trader looks at this and sees the market accelerating upward here, 4 consecutive bull bars, 5 bull bars, and then 6 bull bars, he might decide, well, I'm not going to get out here. I'm just going to stay on in the position until I get a reversal down. In that case, he could get out at the high with a profit on his first entry and a profit on his second entry. In general, if the trader is sufficiently disappointed by this, he would get out break even at his first entry and with a profit on this one. But this is a special case. The market started to accelerate up after a double bottom, higher low. Chances are it's going to go higher. A lot of traders wouldn't care. They would say, okay, it looks like a trading range, not that great a rally, pretty protracted sell-off. It's probably going to have a hard time getting much above this. I'm just going to place a limit order to sell out of my entire position at that price. So I get out break even on my first buy from over here, and then I get out with a profit on this buy. Sometimes traders will look at this and say, wow, this is down 20, 30, 40 bars. That's much further down than I wanted. I'm just going to dump the entire position at break even. So his first entry is here. Second entry, let's say, is here. This is the midpoint between his two entries. So he'll just place a limit order to get out here with this much profit on his first and that much loss on his second. So he's break even on the entire trade. That is acceptable. Whenever you feel sufficiently disappointed by what the market's doing, it's never a bad thing to just get out break even. The bulls who bought this rally, especially those who bought here, were not expecting the pullback to last this deep, almost all the way down to their stop, and for this many bars. That means the trading range is more likely than a bull trend. Because of that, the bulls see a double bottom here, neckline here, maybe a measured move up. They see a bigger double bottom here to here. Maybe we break above this neckline and go for a measured move up. That is unlikely when the pullback is as deep as this. This means the upside is probably going to be limited. So a trading range is more likely than a break above this high, the neckline of this double bottom. I know it's a higher low, but it's still, as far as computers are concerned, it's a type of double bottom. You could also call it a triangle. 1 push, 2 pushes, 3 pushes. But sufficiently disappointing, a lot of bear bars, probably not going to be a big bull trend. This is a fairly big bull trend, but unlikely to go up for a measured move. So you get a double bottom, higher low, major trend reversal. And you get a bear trend here, a bull breakout, and a double bottom. Again, since a lot of traders are going to scalp out at the first entry, and they want to make a profit on their second entry, you want the second entry to be at least as big as a minimum scalp. In the E-mini, for example, you want this to be at least a point below that. And this obviously is several points below that, so it meets that minimum. You don't want to be buying here and then buying more right here. If you're buying up here in the E-mini, you want to be buying preferably 2, 3, or 4 points lower here, not 1 or 2 points. If you're buying in the Forex market on a chart like this, 5-minute chart, 15-minute chart, 60-minute chart, if you're buying here, you don't want this to be just 10 pips lower. After this many bars down, you'd prefer it to be 20 or 30 pips lower, so that you make 20 or 30 pips on this buy, and you get out break even on that buy. Let's look at this again. Trader buys that close, and let's say this blue box is what you normally risk. So you get in there, and you normally would not risk more than that. But look where the stop is. The stop is almost 3 times your normal risk. So if your stop is 3 times your normal risk, you have to trade only 1/3 your position size. And let's say you bought again somewhere in here. Let's say you bought right there, right? And this is your normal risk, the size of that rectangle. And since your stop is down here, on this second entry, you're risking 2 times your normal risk. So you got a total of 5 rectangles. So if your position is buying here and buying more here, your total risk is 5 times normal. And that means that your positions here and here should be no more than maybe 20% of your normal position size. If you cannot do that, if you cannot trade large enough to do this trade, you don't do the trade. Whenever the market tells you what you have to do and your account size or your emotions don't work for what you have to do, you do not take the trade. So let's say you can only trade 2 contracts in the E-mini. You can only take this trade if your normal position size is 5 or 10 contracts. And if your normal position size is not 5 or 10 contracts, just don't take the trade. Don't worry about it. There'll be other trades. total risk if you buy here and buy more here is 5 times normal risk. Your total position between these two has to be about 20% of your normal position size. So maybe 10% here, 10% there, but you got to trade really, really small. And if you cannot trade really small because of your account size or emotions, just wait for a different trade. Again, if you're buying anywhere in this bull trend, doesn't matter if you're buying here or here, the stop is still down here or here. So the market does not care where you get in. All it cares about is where the stop belongs. Now, I said some traders may not want to hold through a protracted reversal down. In other words, they put this as a catastrophic stop in case the market just collapses. They want to make sure they get out without too big of a loss, but they have no intention of ever letting this stop get hit. Well, they can look at this and they can say, okay, maybe a parabolic wedge, 1, 2, 3, maybe 2 legs up, 1, 2, 3, second leg trap, and we get a bear bar here. Maybe I'll just get out below the bear bar. Or big bear reversal bar, big up, big down, probably a second leg down. Maybe I'll get out here. A buy setup, a pullback, but after 2 bars and a big bear bar, probably sellers above here and then a second leg down. So maybe I can exit my long here. So buy here and I'll just get out with a loss there, or below the low 1 or below the low 2. Those are all reasonable things to do. You can stop yourself out, for example, here or here, or right here. So those are all reasonable stops. And the other reasonable stop is right here. And anything in between, I call it a skunk stop, right? Because it stinks and it's in the middle, and the result will be it'll kill your account. If you decide not to take one of the early exits, and you decide you don't want to take the late exit, the far exit, and you said, well, maybe I'll get out below this bar, or maybe I'll get out if it breaks out below that bar. These are losing strategies. In between the quick exit and the distance stop, and these are bad exits. You're in the middle of a trading range and the market's falling below a higher low. Chances are there are more buyers than sellers there. Falling below a higher low in a trading range, chances are there are more buyers here than sellers. So you don't want to be doing the opposite of what most traders are doing. Those are skunk stops. You either get out early, or you rely on your stop, or you wait until the market's clearly bearish. You just don't stick a stop somewhere just because you cannot take the pain anymore, because it's a losing strategy. In this video, I talked about scaling into losing positions. So if you enter a trade and the market goes against you and your premise is still valid, and if you're trading small enough and using the appropriate stop, you can add to your losing position in an attempt to make a profit, or at least to avoid a loss. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This video is on scaling into trades. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 3 videos on scaling into trades. In this video, I'm going to be talking about 2 simple strategies. The first one is when you enter a trade and then you enter a trade again a second time. So you're entering in 2 different parts. For that, I will use an example of an E-mini trade where you buy or sell one contract and then you add to your position, buying or selling a second contract. Next, I'll talk about another sample strategy, this time where you divide your position into 4 different parts. And for that, I'll use a Forex market and 400,000 units. So your first entry is 100,000 units, your second entry is 100,000 units, and your third entry is 200,000 units. So 4 parts, but 3 entries. Here we have a strong bull trend and a double bottom bull flag. You can call it a triangle. We went up and down here. But in any case, let's say you buy one contract above a high 2 bull flag. And let's say you can trade 2 contracts and you're willing to buy more 1 point lower. Again, equal to the distance of a minimum scalp in the E-mini. And let's say you're willing to risk 6 points below the first buy. So if you buy here, you're willing to put a stop 6 points down, and you're going to be buying 1 point lower, so you'll be risking 5 points on your second entry. That means you're willing to risk 11 points to make 1 point. Now, in this particular case, if you're buying this double bottom bull flag, you might put your stop just below the double bottom. Your actual risk is not 11 points trying to make 1 point or 2 points. The risk is not as great as it appears. And if the market quickly goes up for a scalp, assuming you were scalping this, you bought one contract here, it quickly went to your target, and you take a 1 point profit on the one contract. Now, this is a strategy about scaling in two parts. You only put the second part on if the market goes against you and falls at least 1 point below your first entry. And a lot of times, it doesn't fall, it just goes up, especially in a high probability buy. Very strong momentum up. Chances are, if you get a double bottom, a high 2 bull flag, you're going to make money without having to scale in. If that happens, you just take your profit. That's okay. Most traders in a situation like this, after a strong rally, would not be scalping for 1 point. They would be holding and maybe getting out here. Spike and channel up, micro double top here and here, wedge, 1, 2, 3, parabolic wedge, buy climax here. But anyway, most traders would not scalp their entire position here. They might scalp part, but most traders would hold at least part for a swing up. Again, the trader who bought here did not have to scale in because the market never went against him. It quickly went to his target and he took his profit. I talked about the risk when you're scaling in. Most traders should not be scaling in because the risk reward is really bad. You end up getting a very big risk and you're probably not going to get much of a reward, especially if you're scalping. You have to make a lot of good decisions and you need really good trade management. I'll talk about that later on in the video. It's too difficult for most traders to do this consistently well. So let's say you see a strong bull trend, strong second leg up, maybe we'll get a third leg up and a fourth leg up, and it just keeps going up all day. And so you're looking at this and you say, okay, I bought here, I got out here, I want to buy again. I'm going to buy the follow through after this bull breakout bar. Most traders would not do this. This is a series of buy climaxes here, and then here, and then here, and here. Parabolic wedge, the biggest bull bar late in the trend. But the math is still good, even buying up here. However, the chances are you're going to get some kind of a pullback. But let's say you took that worst entry and bought up here again. So you bought one contract up there, arguing a very tight bull channel, first reversal down, minor. The best the bears probably get is a trading range. And then let's say you place a limit order to buy more, 1 point lower. So you buy one contract in the green box and the second contract on the yellow box. Stop is down here. It's 18 ticks below the first entry, 14 ticks below the second entry. So your total risk, if you buy here and buy more here, is 32 ticks, and you're simply trying to make 4 ticks. You're just hoping the market gets back to that green box, so you get out break even on that buy, and with 4 ticks on this buy. And you can say, well, wait a minute, that's crazy. How can I take that buy? You can't risk that much to make that little. Well, the reality is, most of the time, you're not going to buy the worst price. Chances are you'll be buying somewhere in here, and it will quickly go to your target. And also, if the reversal down is strong enough, you're not going to let your stop get hit. You'll get out before your stop is hit. The high close in any bull trend is always a magnet because you have traders who bought it. And usually, a market does not reverse down into a bear trend. It reverses down into a trading range. Any bear selling up here is expecting, at best, a trading range. So he's going to sell, and he'll buy back for a scalp and look to sell again higher. And the bulls know the first reversal down from a very tight bull channel like this is going to be minor. And chances are, for the bears, the best that will follow is the trading range. So the bulls know that if they sell here, trading range goes down and it goes back up. They know that they'll probably be able to get out without a loss. A lot of traders, they buy here. Maybe they buy more here. They place a limit order to get out break even at their first entry, and they make their 1 point profit on their second entry. Some traders would buy here and then buy above a bull bar here or here, and they would make more on their second entry, and that's okay as well. This is a very tight bull channel. It's a micro channel, no pullbacks. It could go up for 5, 10, 15 more bars. And that's why bulls will buy here, despite the climax of this bar and despite the consecutive buy climaxes. They see the momentum is so strong that chances are it's going higher. And even if it does not, chances are they will be able to avoid a loss because the first reversal down will probably come back up and test that buy. Anytime you do a reasonable buy, the market usually allows you to get out without a loss. buying up here, chances are it's going to come back there at some point, and you can avoid a loss. A big bull bar, consecutive buy climaxes here, bad follow through here, bad follow through here, bad follow through here, bad follow through here, bad follow through. When you get a series of consecutive buy climaxes and then you get the big bull bar at the end, chances are you're soon going to go into a trading range. So most traders would not buy up there. But even if you did take that worst entry, it's still not a terrible thing to do. Because if you manage your trade well, you can make money. You make money buying here, or better, buying above a bull bar here, or maybe a double bottom here, maybe above that bull bar there. Only 25% of bull breakouts of bull channels result in stronger bull trends. 75% of the time, if you have a bull channel, even a very tight one like this, the market's going to get at least to the bottom of the channel. And usually you get a couple legs sideways to down. A reversal down after a tight bull microchannel, unlikely to result in a bear trend. The bears usually will need a major trend reversal like this before they can get a swing down. The bull's buying here. Once it does this, they know they bought at a high price, but they're also pretty confident that it will come back to that price and they'll be able to get out, break even, maybe a small loss, maybe a small profit. The reward is small compared to the risk. So if you buy here and buy more here, your risk is very big and the reward is very small. So you have a terrible risk-reward trade, but a 10-bar bull microchannel, you have a very high probability of at least avoiding a loss. And that's always the case. Whenever you have bad risk-reward, you're going to have high probability. Whenever you have high probability, you're going to have bad risk-reward. Your initial risk is 8 times greater than your reward. You can only make money on it if you manage your trade really well. And that's why most traders should be very careful about that. And as far as scaling in, only experts should do that. The main reason why they scale in, is to increase probability. And they know they pay for it by increasing risk. Now they have a bigger position and the stop is far away. Experts routinely scale in to improve risk reward. I talked about how much the trader is risking, that if they buy up here and here, and they're trying to get a 1-point scalp on the second entry, their risk is 8 times bigger than their reward. Well, experts can improve that risk reward. Number one, they rarely will ever let the stop get hit. They'll get out before, so they're not really planning to risk 8 times. Second, a lot of times, most of the time, they're not buying at the worst price. They're buying at a better price. Also, they can increase their reward by scaling in more. And sometimes their second or third entry can be larger than their first. And finally, they can end up swinging part of their trade because this could go up a long, long way. And if it went up a long, long way, it would more than compensate for the terrible initial risk-reward ratio. Now, let's talk about a bear trend. We've been trading down for 30 bars, 40 bars. We got a bear breakout and follow through. Chances are we're going lower. We broke below the low of the past 30, 40, 50 bars, maybe 60 bars. And we have a bear follow through bar. Chances are we're going lower. However, we might pull back deeply. The bears are confident that the reversal up will lead to a second leg down as long as it does not go above the top of the last major lower high. Major to lower high, we have a reasonably strong breakout to a new bear trend low. Any reversal up is probably a minor reversal. In other words, a bull leg in a trading range or a bull leg in a bear flag. A lot of traders, as I said, some will sell more at a fixed interval higher, like a multiple of a scalp. So if it's the E-mini, maybe they'll sell more 1 point higher, 2 points higher. Others will simply say, okay, I'll sell a 50% pullback. So the stop is up here, the bottom of the leg is here, here's 50% pullback. So they sell initially here, and then they sell more here, stop above the top of the bear leg. And their intention is to get out at a minimum, break even on their first entry, and then with a profit on their second. This 50% pullback is 5 ticks above the first, not 4 ticks, so not 1 point, it's 5 ticks. If they get out here, they get 5 ticks profit there and then break even here. Here they're selling above this bear bar, betting that it's a bad reversal. Chances are we'll get a second leg down. I use that as an example. They could have sold the close of this bar, they could have sold the close of that bar, they could have sold this bar as it's forming. I'm just using this as an example of another way that traders often enter in a bear trend. Actual risk was less than the initial risk. The initial risk was above the top of this bear leg. Their actual risk was here. Actual risk was a total of 15 ticks, and that's a total of 10 ticks on their first entry and then 5 ticks on their second entry. A lot of bears would swing, but they'll look at this and say, oh, I don't know, this is a pretty big reversal up. Maybe the premise of a bear trend is not so good. Maybe it's just going to be a trading range. So they'll be sufficiently disappointed by the number of bars and the tightness of this bull channel to just get out break even on their first entry and profit on their second. I want to talk about another strategy. This time, instead of entering with 2 parts, I'm going to talk about entering with 4 parts, and I'll use a 400,000 unit Forex position as an example. Same chart as we had, and let's say it's a Forex chart this time, and let's say you're willing to buy a total of 400,000 units, and your stop is far away. Instead of buying 400,000 units here, you just buy 1/4 of that, 100,000 units. Again, same problem, very tight bull channel, consecutive buy climaxes here, 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 and here. Probably will turn into a trading range soon, but strong enough move up that the first reversal down will probably be minor and lead to a trading range instead of a bear trend. The bears will probably need a lower high major trend reversal or some kind of major trend reversal before they can get a swing down. You know, you could have bought anywhere in here. Maybe you bought, you took a profit, bought and took a profit, bought and took a profit. And you bought here, and then it did this. And you said, well, I don't care. It's probably a minor reversal, and we'll probably get a trading range, and I'll probably be able to either make money or avoid a loss. But I do know one thing, no matter where I bought, even if I bought the absolute worst price, my stop is below the bottom of the bull leg, the bottom of this major higher low. If the market falls below this, then the premise of a bull trend is no longer valid. You can see later in the day what happened when it fell below it. The bulls gave up, and the bears sold the rally for a second leg down. This strategy involves 4 parts. So you buy 1 part here, 100,000 units, let's say the euro versus the dollar, and you might want to place a limit order to buy 100,000 more, 10 pips lower, 10 pips the minimum scalp size. And then I said 4 parts, but I did not say 4 entries. Let's say you were willing to buy an additional 200,000 units, in other words, a double-sized position, if it falls to a second scalp size down. Okay, so you buy this 10 pips below that, and then this, you're looking to buy above a bull bar, reversal up here. This is actually 18 pips below the first entry, not 2 times the scalp size, but close enough. Ideally, you'd rather have this be 3 or 4 times the minimum scalp, so you'd rather have it be 30 pips below the green entry, maybe 40 pips below. 20 pips is pretty much the minimum that you'd want for a third entry like that. Probably sufficiently disappointed by this so that you'll be happy to get out around your first entry, because after you see this many bars sideways to down, you're probably concluding that the market is now in a trading range instead of a bull trend. If it's in trading range and it gets high, back to the original close, it's probably not going to go much higher. So you buy 100,000 units here, 100,000 units here, and then 200,000 units here with the plan to get out around your original entry, that green box. So you make 0 pips on your first entry, 10 pips lower here, so you make 10 pips on that entry, and you make 18 pips on this entry, but it's a double-sized position. So you made 36 pips on your third entry. Total risk, 100,000 units to here, 100,000 units to here, 200,000 units to here. Total risk is 196 pips. And you made 36 pips. But remember, you're not planning on letting your stop get hit. You would get out before your stop would get hit. Also, you're probably not going to enter on the exact worst price like in the example that I just gave. Let me talk about a bear example. And you can divide your entire position into 4 parts. Here we have a trading range, and the bulls know the market should not fall below the bottom of this major high or low, and if it does, then the premise of a bull trend is no longer valid. You have to then be thinking that maybe we're in a trading range or a bear trend. Well, clearly we're already in a trading range, and here we did get a bear breakout and follow through. Chances are we get at least a little bit more down. So with that in mind, let's say you sold above the high of this bear bar, betting against the reversal up, and let's say you sold another 100,000 units 10 pips higher. The minimum scalp 10 pips. And then you look for a bear bar, and you sell below a bear bar right here, and you decide that for your third entry, you're going to have it be a double size. So this is a quarter of your position, and this is half of your position. So you have a total of 4 parts, but only 3 entries. In general, you want this entry to be at least 3 times the size of a minimum scalp, like 30 pips above this, but sometimes you don't get it. And here you get a bear bar. Selling below a bear bar and a bear flag, especially if you're scaling in, that is a reasonable thing to do. The size of the rally is enough to make you concerned about your premise of a second leg down. It makes you wonder if we're simply going to go sideways here, maybe a trending trading range day, upper range, brief breakout, and then lower range. Because you're probably fairly disappointed by the extent of that rally, you might place a limit order to get out break even at your first entry. So you get out break even on your first entry and 10 pips profit on your second entry. This is 13 pips higher than that, but it's a double-sized position, so you make 26 pips there. You make a total of 36 pips. Total initial risk from this trade to there, plus this to there, plus this, a double-sized position to there. Total risk is 106 pips. But your actual risk was 7 pips less per trade because we never got to your stop. So the actual risk was 1 pip above this, and your actual risk was 78 pips, and you made 36 pips on the trade. You don't always enter at the worst price. Here, it does make sense to enter at the worst price. You don't always scale in 3 times. A lot of times you'll just sell here and then sell more below a bear bar. Usually the pullbacks are not that deep. Usually the trend reversal down is stronger. So this is an example of pretty much a worst case scenario. The only thing that could be worse is if your stop got hit. Most of the time when you're scaling in, you're not going to be risking 78 pips to make 36 pips. I'm just giving you several examples on scaling in trades, and there are many different ways to do it. And if you're an expert trader, you're very flexible about it. There's no fixed, rigid way to do it. I'm going to sell 10 pips higher, 20 pips higher. Some traders do that. Other traders, instead of selling a fixed number of pips higher, they'll sell a 50% pullback right around here. Or they'll only sell their second entry below a bear bar, and that second entry has to be at least 2 or 3 times bigger than a minimum scalp. All of the ways are good as long as they're logical and make good sense mathematically. Management after you enter. Many choices. Do I get out break even on my entire trade, or do I try to get out break even on my bad entry and then with a profit on the other entries? Do I swing part or all of the position? And because of all those decisions, it's really easy to make a lot of mistakes. And therefore, when you're trading like this, if you are going to be scaling in, especially scaling in a second time and a third time, you should only be doing it if you're an experienced trader, a profitable, consistently profitable trader. You also have the issue of emotions. If you sell here and you're starting out and then you see 4, 5, 6 bars going up against you, are you really willing to sell more here and sell more there? Probably difficult to do. And you probably are not trading small enough because your account size will not allow you to trade a small enough position. There are just structural problems that a trader has as a beginner that prevents him from managing these trades well. So they should not be taking trades like this. I made the point, you have to have a big enough account to allow you to trade this properly. A really important problem here is position size. And I think a lot of beginners think they can scale in and manage their trade correctly, but they really have no intention of allowing the market to get anywhere near their stop. Maybe he sells here and sells more here, and then when it goes here, he takes a loss on both, thinking, oh my gosh, I really didn't want to risk that much. But you only can take this kind of a trade if you can trade small enough. Let's say you can only trade 4 units or 40,000 units. You should only trade 4 units or 40,000 units or 4 contracts or whatever if you can honestly, comfortably trade 8 to 10 units or 80,000 units or 8 to 10 contracts. You have to make sure that you're trading no more than half of a position size that is normally comfortable for you. The single biggest loss with this is beginners are not trading small enough, and then when the market gets near their stop, they exit. All they're thinking about is risk. There are 3 variables: risk, reward, and probability. Beginners only think about risk, and they ignore probability, and they ignore reward, and they manage trades based entirely on risk, and they end up losing money. There are 3 variables, and you always have to be considering all 3. And that is really difficult for a beginner. All right, so let's say we get a bull trend over here, and you're buying for any reason. And let's say you happen to buy late, hoping that the swing will just continue up forever. You know, with consecutive buy climaxes here, 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 and now a 4th one, we're probably not going to go much higher. We might, but you also know that you're probably not going to lose money if you buy here and manage your trade correctly. A lot of traders in this situation, if they buy here, they trade small enough to allow themselves to add on, scale in lower. So let's say you buy there, and then you see this parabolic wedge or consecutive buy climaxes, and then this final big bull bar, a buy climax, end of the trend. A lot of scalpers will just get out below that reversal bar. They know that this is probably going to do this, go sideways, and that the up move is probably over. So if you're a scalper and you buy there and you did not scalp out here, you got to get out here. And some swing traders who bought here, when they see this, thinking that they'll think that we'll get a couple legs sideways to down, so they will get out as well, looking to buy again lower. A lot of traders do not get out. They say, hey, as long as it stays above this stop, the bottom of this major higher low, I'm still good. I'll take my buy here and I'll look to scale in lower and see if I can make more money. High 1 and high 2. So some traders, if they buy here, they'll buy more here. High 2 bull flag. But because the market sold off so much, their premise of a relentless, strong bull trend is no longer valid. Now they're thinking either weak bull trend or trading range. And because of that, they'll try to get out, break even around the high close, or maybe just simply break even at their original entry, which would be over here. Bears, bull trend, bear break below the bull trend line, and a couple legs up, 3 pushes up, and possibly a higher low major trend reversal. And they see that it's a test of the high close of the day, and it's reversing down. So some bears will sell that, just like the bulls will take profits there. Whenever bulls think something is good enough to take profits, there are always bears thinking it's good enough to sell. They might sell up here with a limit order at that high close or with a stop on the way down. On the way up, we're rallying strongly. Buy the close all the way up. Let's say you buy this close. What do? Your stop is down here. You took the final buy the close entry. You did not know that when you took the trade, but you only take that trade if you're willing to use your stop down here. And a lot of the traders who take that trade will only take that trade if they're willing to scale in more. They look for a bull bar, especially a micro double bottom, a high 2 buy. So you buy here and you buy the high 2 bull flag. And if you're sufficiently disappointed by the size of that sell-off, you don't try to make a profit. You don't try to get out here. You might instead say, oh, this is just too many bars down. However, I should be able to avoid a loss. And the midpoint of my entry is, here's my upper entry, here's my lower entry. I'll try to place a limit order to get out, break even on the entire position, which is halfway between the 2 entries, and you get out there. Sufficiently disappointed that you think big up, big down, big confusion, trading range more likely than a bull trend. Trading range, you buy low and you get out in the middle or near the top. In this video, I gave two different examples. The first was an E-mini example in which a trader trades two contracts. He enters with one contract, and then if the trade goes against him, he enters again with one contract. His total position then is two contracts. In the second strategy, I used an example of a Forex trade in which a trader is comfortable trading 400,000 units, and he divides his position into four parts. He enters the market with one part, 100,000 units, and then as the market goes against him, he enters again with another 100,000 units, and if the market further goes against him, he takes a third position, but this time with 200,000 units for a total position size of 400,000 units. And I talk about how to manage the trade. I'm Al Brooks. Thank you for watching the Brooks Trading course. This is the third of 3 videos on scaling into trades. This is Al Brooks. Thank you for watching the Brooks Trading course. This video is on trade management and on taking profits. I'm going to be talking about management, and by management I mean what you do after you enter a trade. I'm then going to talk about OPM, other people's money. That's a concept that you sometimes hear if you have an open profit. Oh, it's other people's money. And the implication is that you can trade it more recklessly because it's not really your money. But the truth is, once it's in your account, it is your money. Trade management, it's what you do after you enter the trade. Traders take trades for any reason, and they always have a goal, a profit target, and they always have a means of protecting themselves if the goal is not reached. For example, a protective stop. By managing a trade, I mean following your plan. If the price action is doing what you expect, you follow the plan. If the price action is doing something other than what you expect, you have to change your plan. And you always have to be willing and ready to exit, even with a loss. If your premise is no longer valid, you have to get out. For example, we have a double top. We also have a small double bottom here, but we have a trading range with a double top, and we broke above it and we went sideways. Traders could buy above this bull bar or above that inside bar, and they get long over here on this bar. You have to have a plan. Initially, you might plan to take profits at a measured move up. So the bottom of the trading range, the top of the trading range, and the profit target would be up there. However, what do you do when you get this? You have a strong reversal down, yet the market did not reach your target. Well, what you do is the market clearly has done something very bearish, and the odds now of the market reaching your target are much less. So just exit. You can either exit on the close of this bar or on the reversal up, betting that there'll be at least some kind of a second leg down. Here we got a strong bear breakout, a rally to a lower high, and then we did get a second leg down. We have a pair of consecutive strong bear bars closing on their lows, totally reversing this final bull breakout. So the odds are we're going to go sideways to down, and the chance of the market reaching your target is considerably less. So it's better just to get out. I often talk about the trader's equation. The probability of success times the size of your intended reward has to be greater than the probability of losing times the possible loss, the distance to your stop. You want that to be positive. You need to protect your profits. You need to let them grow. However, you got to take them before they disappear. As far as strict rules go, there are no strict rules. All you have to do is be logical. And anytime you do something that results in a positive trader's equation, you're doing something that mathematically makes sense. So you're doing something that's reasonable and acceptable. In other words, you can do it. We have a bull trend. We have a bull breakout and a pullback. You can call it a wedge bull flag. 3 pushes down, 1, and then 2, and then a pause, and then 3. So it's a wedge bull flag around a 50% pullback. Traders will buy above this bar. It's a small bull bar. When you're not sure where or when you should take profits, always rely on the trader's equation. You can always take profits whenever your profit is 2 times your initial risk. In fact, the math is, I think, based upon actual risk, but you can use initial risk. Here, the initial risk, if you're buying here, Are you going to put your stop below the bottom of the wedge bull flag? Probably not. We could easily drop another one or two small legs down, and your premise of a bull trend is still valid. So your stop is probably below the bottom of this bull breakout, like maybe below these bars or maybe below that bar. You enter here, just above this bar. Your initial risk is below the bottom of the bull breakout. 1 times your initial risk is here, and 2 times your initial risk is here. So if you buy here and put a stop here, the math is always good if you take full or partial profits here at 2 times initial risk. If you do this all the time, you will make money. Even if you only win 40% of the time, you will make money. The trend kept going up, and every institution has a way of protecting its profits, and it does not want the risk to be too far. So if you buy here and your initial stop is here and the market keeps rising, are you going to keep the stop down here? No, at some point the risk is too great and you have to reduce your position, or you can try to reduce your risk. One way to reduce your risk is by tightening your stop. So you trail the stop, you move the stop up, usually to the bottom of the most recent bull trend. Here we have a reasonably strong bull breakout. So this is a major higher low. And once the market is somewhere up in here, traders will say, okay, I don't want to risk all the way down here. My premise is a bull trend. We should be getting higher lows, higher highs. If it falls below a fairly major looking higher low, my premise is no longer valid. So when the market is here or anywhere up in here, a lot of traders will raise their stop to below the bottom of this major higher low. Now, let's say the market is up here and your stop is down here. That's a much bigger risk than when you bought here and your stop was here. When you bought here with a stop down here, you traded with a position size that was appropriate for this size stop. Now the market is up here and you're risking much more. You can say it's other people's money. Fine. I would not say that. I would say my risk is greater than what I want it to be. And can I move my stop up here? I think that would be a mistake. That's a minor higher low. The only other way you can control your risk is by reducing your position size. And when institutions reduce their position size, they're selling out of their longs. So you have bullish institutions now selling. And what happens? You get a pullback. And if the institutions are reducing their position, they often wait 5 or 10 bars to see if the reversal down, the profit-taking reversal down, is the start of a bear trend. If it's not and the market stabilizes, then they'll buy again. You just arbitrarily reduce your position size. Oh, the market's going up. I'm going to reduce my position size. It's usually better to do it at some kind of support and resistance because a lot of institutions will take profits at support and resistance. This is a bull trend. Now, where's the support? Look for it. One way to look for it is look for a gap. We have a bar here, the close above it, and then the low of this bar is at or above that high. And then the same thing here. We have a breakout bar, a bigger bar, and then followed by a bear inside bar. The low of that bear inside bar is above the high of this bar. That's the breakout point, this high, and the pullback is that low, and there's a gap. The trend started either here or here. A measured move up takes us here. And a lot of institutions will take partial profits here. Especially when the trend is pretty strong, they'll often take profits at 1 times the initial risk. At this point, we got this pullback, and it looks like we're forming a gap once we start up again. The stop is down here. 1 times risk is up here. When there's a high probability trade like this, when you're in a breakout, the probability is high that the market's going to go higher. Traders will often take profit at 1 times initial risk. You can also look at it as a leg 1, leg 2 move. We got a breakout and then a small pullback. And then the market started up again. So we have a leg 1, leg 2 measured move. And the profit taking, traders reducing their position size, results in a pullback. Traders need to protect profits and they have to let their profits grow. And you can do that by using initial protective stop. You can use trailing stops. You can use break-even stops. Here we get a reversal down from a lower high with a strong bear breakout and a follow-through bar, and then another follow-through bar and another. Somewhere in here, you have to decide the odds are the market's going to go down rather than up. The market's always in short. A lot of traders will sell the close of either this follow-through bar or this one here. Where's the initial stop? Well, at the top of the initial leg down. This is the strong breakout. It began here. You could put your stop up here, but most traders would consider this a major lower high. If the market gets above this high, their premise of a bear trend is no longer valid. The market would either be in a trading range or in a bull trend, so they'll put their stops above that high. We get another bear breakout here, and what do? Do you still keep your stop up there? Probably not. Traders might put their stop above here. This is the top of this leg down, or they might simply put their stop above the top of this bear breakout. What happened here? We have a bear breakout and then a bull bar for the follow-through bar. This might be a failed bear breakout and the start of trend up. We have a bear trend, a protracted trading range, and then a bear breakout. You could call this a lower low major trend reversal. So if you did get out above this bull bar and the bulls failed to get a strong bull breakout and this rally failed to get above this lower high or that lower high and the rally lacked consecutive big bull trend bars, so it looks more like either a bull leg in a trading range or a bear flag, you have to be thinking about getting short again. And you can call this a wedge. There are 3 or 4 pushes up here. There's a first leg up here and then a bear bar, first leg, and then another pause here, second leg, third push, fourth push. A lot of traders will sell the reversal down. I don't have it drawn in, but I could draw a line across the top of this bull channel, and we broke above it and are starting to reverse down. That's another good reason to short, especially since the market is still always in short. Once it starts down, traders will say, okay, maybe I'll put my stop above the top of this bar, because if it gets above that, maybe it's no longer a bear trend, maybe it's a trading range. So they sell here, stop up here. That's their initial risk. Here's 1 times initial risk. Here's 2 times initial risk. Traders might plan on exiting at 2 times initial risk, especially since the past 50 bars are small and the range is small over the past 50 bars. So your target is going to be smaller than traders selling up here where the bars are big and the swing is big. But look what happened. It did not fall below 2 times initial risk and started to turn up. And so it did not reach your scalper's profit. And what do? A lot of traders will say, well, it's not great. It did not reach my target. It got very close to it. I'm looking for a scalp. I don't want to lose any money. Maybe I'll simply move my stop to break even. Mathematically, break-even stops are stupid. There's no mathematical basis for using a break-even stop. A lot of times, I would simply buy back my short on the reversal up, or I'd leave my stop above the top of the bear leg. But realistically, a lot of traders, when they're scalping, if it doesn't go their way, they'll quickly just move their stop to break even instead of trying to move it exactly above the high of this small bar. A lot of times it's simply easier. If you're using a price ladder, for example, you can see exactly where your entry price is. A lot of traders will quickly move their stop exactly to that price. If you did not exit on the reversal up, and if instead you moved your stop to break even, your stop did not get hit here, the market resumed down again, and a lot of traders would simply try to scalp out at that prior low. And you can see we fell below that prior low. It's around 2 times initial risk, and they'll take profits there. They certainly will exit on the reversal up because this is not behaving like a bear trend anymore. We have a bear breakout here, but a very weak second leg down here, and it looks like we're starting to enter a tight trading range. OPM, other people's money. It's never true. Once the money is in your account, it's your money. I really think it's a pretty dumb concept. We have a bear breakout here, big bar, closing below the low of the past 10 bars, probably a measuring gap, and probably fall from there. So let's say you sell that close of this big bear bar right there. Where's your initial stop? Probably just above the top of the bear leg. You don't want it to get above this bar. If it does, your premise that we're at the start of a bear trend is probably wrong. The market fell and then went sideways. We have a double top bear flag, low 1, low 2, and we went up again here. You can call it a low 3 or a triangle. Does not matter. And then we reversed up here. We have a very good bull bar closing near its high, a very strong bull reversal bar, and we have a potential final flag. Can a beginner hold short thinking that all of this profit is somebody else's money? Can he hold short and say, I don't care if it comes back to my target. I'm not losing any money. That's other people's money. Some beginners will do that. They'll move their stop to break even, hoping that we'll just keep channeling down. No, you cannot do that. That's just totally dumb. Once the money is in your account, it's your money, and you have to protect it. And this is a strong buy signal, so you have to buy. You have to buy back your shorts. And if you're able to, you can go long. Think about this for a second. You're arguing that this is somebody else's money, even though it's in your account. Let's look at it from the other side. Let's say you bought here instead of sold, and the market is falling, so now you're losing more and more money. The money is no longer in your account. Do you pretend that it is in your account, even though it's in somebody else's account? No, you no longer have any control over it. It's not your money. It's in somebody else's account. Likewise, if you sold here, there is money in your account that was not in there earlier. It's your money, and you have to manage it like your money. It doesn't matter if you sold here, or if you sold here, or if you sold here. The management is the same. Management has nothing to do with entry price. It has to do with price action. And it doesn't matter where you sold, anywhere in here. Once you see this bar, you have to get out. As I said, once you're in a losing position, that money is in somebody else's account. It's their money. Don't worry about it. It's no longer yours. You no longer have any control over it. I talked about this as a triangle. You can call it a double bottom. Let's say you bought above this bull bar. 3 pushes down. We went down and up on this bar, and then down on this bar, and then up and then down. So you get 3 pushes down. We have a breakout and then a pullback with a good-looking bull bar. So let's say you bought above this bull bar. It's a triangle. Arguably, it's a reasonable thing to do. And what do? What I would do is I would get stopped out with a loss because I think we're still always in short. So I don't want to be holding long if the buy signal reverses down below the bottom of the trading range. I would just get stopped out with a loss. If I lose, I don't look back and say, darn, I feel bad. I shouldn't have done that, or I wish the market didn't do that to me. I wish they didn't take my money. I never look back. When I'm trading, I always look forward. I'm only interested in what hasn't happened yet. What has happened, it's over. It's history. I cannot change it. And if I'm looking back, I'm going to miss the next great trade. So if I'm at this point saying, darn, I just lost money and I just feel bad and I'm going to take a break from trading, and then you miss this. You cannot do that. You have to not feel bad over a loss. You're going to lose. Everybody's going to lose. Even a great scalper is going to win 90% of the time. That means he's going to lose 10% of the time. And if he looks back at his losses and is dwelling on them, thinking about them, he's not going to be mentally prepared for the next trade. And sometimes it's a great trade like this. A strong final flag reversal with a great looking bull bar. That's a great trade. You got to take it. If you don't buy here, you got to start buying closes somewhere up in here. And if all you're thinking about is, darn, I lost money, well, you miss a great opportunity to make back many more times than what you lost. Take a look at this slide. Let's look at the bear side of it over here. There are many reasons to get short on the way down. You could sell this as a double top bear flag. Here we have an exceptionally big bear breakout. We have another one here. Here we have an attempt to reverse that is weak, so a lot of traders will sell at a limit order at the high of this bar, betting the bull reversal will fail. And then here you can call this a double top bear flag. You can call it a low one bear flag. Traders will sell there as well. It doesn't matter which one of these entries you took, your stop is still going to be the same up here above the top of the bull leg. Some traders sold early on, other traders sold late. It does not matter. All of those bears are going to manage their trade the same. And all of those traders have to get out above this bull reversal bar. This is a strong buy signal, so traders must exit. It does not matter if you shorted right here and you're thinking, oh my gosh, that's not enough profit, I don't want to get out. You're going to get out because that's what you have to do. The market is telling you that your premise of a bear trend is no longer viable. You always have to manage your trades based upon the current price action. All that matters is, where's your stop? Where's your target? Is the premise still valid? And for all of these entries, you have to get out right here. Your stop is up here. Maybe after this bear breakout, you might lower your stop to here. But in any case, this is a good buy signal and you have to get out, no matter if you sold here initially or if you sold up here. So entry price has nothing to do with trade management. All that matters is the stop location, the target, and whether or not your premise is still valid. In this video, I talked about management, which is what you do after you enter a trade. I then talked about other people's money, and it's a stupid concept that's never true. Anytime money is in your account, it's your money, and you have to manage it like any other money that you own. I'm Al Brooks. Thank you for watching the Brooks Trading course. This video is on trade management and taking profits. This is Al Brooks. Thank you for watching the Brooks Trading course. This video is on trade management and on taking profits. I'm going to be talking about management, defaults that traders can use when they're deciding how to take profits. Obviously, you want to take profits before they disappear. And you have to have a goal when you enter your trade. And then you adjust your goal as you see the strength of the move. For example, let's say you sell this bear breakout down here, hoping that maybe we'll get a measured move down. So leg one, pull back leg two, or simply a measured move based upon the height of the bear breakout, pull back, and then measured move down. Let's say you're hoping for a measured move from the open of the first big bear bar to the close of the second big bear bar, and this is 1 times that move. It's a reasonable target. And then you see the market reversing up strongly before it gets to your target. Should you wait and let your stop get hit, hoping that the target will eventually be reached? No. The premise of a measured move down after you see this reversal and the market going above the high of that strong reversal bar, your premise of the measured move down is no longer valid. So you have to exit. We got a strong bear breakout. You might trail your stop up here. And then we got this strong bull reversal bar. Most traders will get out above the high of this bar. Should you just get out on the close of this bar? I would not, because sometimes you get the strong bull reversal bar, and then the trend continues down, and the market does not go above the top of the bull bar. So I think you move your stop to above the high of this bar, thinking that it's a valid buy setup. So bulls will be buying there. Bears should get out there. You just exit, and your premise of a measured move down is no longer valid. So just get out as the market reverses. Remember, you have a final flag, and then you get a reversal from the final flag. The bulls are going to be buying this. They see a bear trend, a trading range, potential final flag, a trading range late, and a bear trend, and then a very strong reversal up. So bulls are going to be buying here. Most traders who buy this reversal will put their stop down here. So their initial risk is from just above the high of this bull reversal bar to just below the low of that bar. So that's their initial risk. This is a reasonably high probability trade. You do not have to hold for a profit that's 2 times your risk. You can get out with a profit that's just 1 times your risk. You buy above the high of the bull bar, stop below, and this is 1 times that risk. And that is reasonable to get out there. Reasonable does not mean ideal. Just because something makes mathematical sense doesn't mean that it's the best choice. Mathematically, it's always good to take part off at 2 times your initial risk. So this is 1 times initial risk, and this is 2 times initial risk up there. I'm talking initial risk. The trader's equation uses actual risk. So if you buy just above the high of this bull reversal bar, and let's say the market just kept going straight up, your actual risk may have been 1 tick, or 2 ticks, 3 ticks. If you're trading Forex markets, it may have only been 2 or 3 pips. However, with the bars this big and the reversal this strong, you do not want to be getting out at 2 times your actual risk. If your actual risk is only 2 ticks or 2 pips, you don't want to be exiting with just 4 pips profit. Most traders would base their profit target on initial risk, which is below the bottom of the buy signal bar. You could get out mathematically. This would be okay. It's the top of a trading range. High enough probability, strong enough momentum up. Look at this. We have 6 consecutive bull bars up here. Do you really want to be exiting at 1 times your initial risk? While mathematically it's reasonable to get out at 1 times initial risk, the context is good for probably a couple legs up. And at this point, we only have 1 leg up. And with the 6 consecutive bull bars, the probability is we're going higher. So most traders should take their profit at 2 times the initial risk, or at least partial profits up there. I talked about actual risk. I'm saying actual risk is to below the low of this bar. It might not even be there. You get the reversal, you buy above the high of this bar, so you get filled right here. And the market may not have pulled back there, but let's say it did pull all the way to the low of the bar and then went up. So your actual risk is only that big. It's a strong reversal, high probability of making a profit, so you could always exit at 1 times actual risk. Mathematically, it would be okay to buy here and exit there. And if you do that 100 times, you will make money. It's a high probability trade, so 1 times actual risk is mathematically reasonable to do. However, just because it's mathematically reasonable doesn't mean it's the best thing to do. It's rarely the best thing to do. When the actual risk is small like this and the probability of a big profit is high, it's much better to go for a bigger profit. As long as the trader's equation is positive, you can always exit using that target. I talk more about this in the video on actual risk. While it's okay to get out at 1 times actual risk, when there are obvious targets that are better, more profitable, with still good math, still a good trader's equation, it's better to be looking at them. Let's say you held long and you were planning on getting out at maybe 2 times initial risk. Initial risk here, you buy here, risk is here, 2 times initial risk is somewhere up here. And then you see this. We broke out and we pulled back, and this is a breakout test of that high. I don't know if this slightly overlapped that. It doesn't matter if it's a slight negative gap. By negative gap, I mean the pullback slightly overlaps the breakout point. It doesn't matter. It's still a possible measuring gap. So from the low here to the breakout test here, you project up, there's 1 times the risk. And that would be a reasonable target. So buying here, you could get out 1 times actual risk, or you could look for other targets based upon the price action, and it would be reasonable to buy a measured move up based upon the height of this leg down, especially once you have this breakout test reversing up after testing the breakout point. You have a good chance of a measured move up, and this would be a good location to take profit. Obviously, a positive trader's equation because it's far more than 2 times actual risk. Again, it's always mathematically acceptable to take profits at 2 times actual risk, and that means it's always acceptable to take profits at 2 times initial risk, which is greater than actual risk. So let's say actual risk is to just below the low of this bar. It's probably less. It probably did not go down here after triggering the entry. Then this would be 2 times that risk. Here's your actual risk. Here's 2 times your actual risk. So it would be okay to take profits, full profits, 100% of the time here. Initial risk, here's your entry price. So you risk from there down to here, and this is 2 times initial risk. So mathematically, it's okay to take profits at 2 times there. One choice is, if you want to take bigger profits, is maybe take half off at 2 times actual risk. So actual risk, 1 times actual risk, 2 times actual risk. Take half off here, and take another 25% off maybe at 3 times actual risk, and then let the remaining 25% go as long as the trend is valid. And you can use the same logic to initial risk as well. Maybe take 25% off at twice the initial risk, and another 25% off at 3 times the initial risk, and swing the remainder and get out if your premise looks like it's no longer valid, maybe after the close of 2 big bear bars or 3 big bear bars. We have a huge bear breakout, high probability of lower prices. This is the euro versus the dollar, a 15-minute chart. Probably going to get a spike and channel down. Let's say you sold the close of this bar, and your initial stop is at the top of the bear breakout, and it's about 95 pips above. So your initial risk is 95 pips. If you typically risk 20 pips on 100,000 units, and this risk is 5 times bigger, you have to trade 5 times smaller. So maybe you trade 20,000 units. So you sell 20,000 units. Alternatively, you can argue that this bear breakout is so strong, the market should not get much above a 50% pullback. So maybe put a stop slightly above a 50% pullback. 50% pullback maybe here, put your stop slightly above. In that case, you could trade a little bit bigger, maybe 40,000 units. Strong bear breakout, probably going to get a measured move down, maybe based upon the open of the bear breakout to the close of the bear breakout. Measured move down would be somewhere down there. At this point, I think probably a 60% chance we're going to get around a measured move down from the open of the first breakout bar to the close of the second breakout bar, and this is the measured move down. Probably, whenever I say probably, that means I'm at least 60% certain. If you plug 60% into the trader's equation, you can exit at 1 times risk and have a profitable strategy. 1 times risk means bad risk reward. Your reward is only as big as your risk, and that's not a strong risk reward profile. But that's always the case whenever you have a high probability trade. When you're selling down here, some institution is buying, and they know that the probability is they're going to lose money, but they also know that they're going to have a pretty good risk reward profile. They buy here and maybe put a stop here, maybe even a stop down here, and plan to scale in, buy more lower. You're getting high probability, they're getting low probability, but they're getting reasonable risk reward. We have another bear breakout here, so traders might lower their stops to above here. Strong enough breakout to expect at least a little bit more down, at least another leg down. We have another bear breakout with follow through here, so a lot of traders will say this is a major lower high, and they'll trail their stop down. Initial stop was up here, and then after this breakout, they trailed it down here. After this breakout, they trail it here, just above the top of this bear leg. Same thing here. Another bear breakout, stop is up here. Do they get out here? We have a micro double bottom, and we're trying to reverse up. We have a series of bars in a bull micro channel, no pullback. Well, you could get out above that bull bar, or you could rely on your stop. You could say, well, we got close to the measured move target twice, and we're reversing up. Maybe I should get out here. That is reasonable. It's also reasonable to hold and then get out either at that low or at your initial target. There are always other reasons to exit as well, but you have to look for them. For example, you could draw a channel, this pink line, and this is at the bottom of a channel. Or you could say 3 pushes down, 1, 2, and then 3. And it's almost to the measured move target. We're very close to it. We have a big bear bar late in the trend. In fact, this is the biggest bear bar probably in the past 40 or 50 bars. So you have to be thinking that it's probably an exhaustion gap, which means we're probably going to close the gap between the close of this bar and the close of the prior bar. Usually what it means is the market's going to get to the top of the bear bar. And here we have a low one short, a breakout pullback short, a breakout and a pullback, but not a particularly strong looking sell. Because it's a weak sell and we're at the bottom of 2 channels and we're right near a measured move target and we have the biggest bar late in a bear trend, this is a weak sell setup. Bulls will buy below that bar, betting that the bear breakout will fail. And if bulls are going to buy, it's reasonable for the bears to buy back their shorts, even though it's not a clear bottom. You could continue to hold short, but most traders would end up taking profits at a new low, especially since it's at the measured move target. So there's very little left to gain by holding short. Here, we got a pretty strong reversal up. Why did we get that strong reversal up? Because the final bears bought back their shorts. It hit their target. The trend was weakening. We have a potential exhaustion move here. We have a decent rally here. And bears see that, so they think there's not much left to the trade. If they did not buy back their shorts at the target, they'll buy back their shorts on the reversal up. It's a lower low major trend reversal. Let me look at the math a little bit here. Initial risk was to above the high of this bear breakout. So they're initially risking about 95 pips if they sell here. Actual risk was only 9 pips. You sell this close, it rallied 8 pips. Your stop is 1 pip above, so your actual risk is only 9 pips. If a bear exited here, he would have 77 pips profit. Because the breakout was strong, once we started down, you can see your actual risk is 9 pips. After a strong breakout like that, you knew there was at least a 60% chance of making at least 1 times actual risk. And you could exit at 1 times actual risk. So there's your actual risk. You can exit 1 times actual risk. But just because something is mathematically reasonable doesn't mean it's the best choice. Also, remember, it's 9 pips. Do you want to be taking a 9 pip profit? Of course not, because when you're scalping in Forex markets, all of your trades should be at least 10 pips. That's the minimum scalp size. Scalping for less than 10 pips is rarely going to be a profitable strategy. This is 1 times actual risk. So you sell here, theoretically, you could get out down here, but that is, I think, not a very good thing to do. You should avoid taking small profits when there's a big move that is likely. Actual risk can be used to find a minimum target, but minimum does not mean the best. So if you think there's a probability of a big move, don't exit at 2 times or 1 or 2 times actual risk. When you see a strong breakout like this, there's a 60% chance that breakout will lead to a measured move. Even if it's mathematically acceptable to scalp out either here or here, that does not mean it's a good thing to do. In fact, you should not do it. I'm talking pips. When you trade Forex, you're always talking about pips. If you search online, there are lots of Forex profit calculators. You can use them to estimate the profit in US dollars. And that's not only for the euro versus the dollar, that's for any Forex product. For example, the euro versus the yen. You can plug in the number of pips and the prices and the unit size, how many units you're trading, and the calculator would tell you how many dollars. For example, here, if you ended up exiting down here, you sell here, you exit here, you made 77 pips profit on 50,000 units. And if you plug it into a Forex calculator, profit calculator, the profit would be about $485. Now, instead of selling 50,000 units, let's say you sold 500,000 units. Then your profit is about $4,800, close to $5,000. And the reason I bring that up is because $5,000 is a magic number for traders. Because if a trader is able to average $5,000 profit a day, that translates to about $1 million a year. If a trader is starting to become consistently profitable, they start thinking about making $1,000 a day, $2,000 a day, and then they realize that, hey, if I make $5,000 a day and I trade 200 days or 200 plus days a year, that translates into $1 million a year. So $5,000 is a magic number for traders. Here we have a rally, and then we gapped up on the open. And the market tried to reverse down, bear bar. It tried to resume up, and then it tried to reverse down again a second time. So this is a failed breakout above yesterday's high and a second entry short. That's a 60% probability trade of making money if you take that short. Second failed breakout above yesterday's high, and you have a decent sell signal bar, so we're probably going to go lower, and we'll probably make at least 2 times the initial risk. And then look what takes place here. A tight trading range late in a bear trend. It's possibly the final bear flag. Tight channel, still always in short, but you might get a couple legs up. Here you got one and not a second. Because of the possibility of a final flag and 2 legs up, it's okay to take partial or full profits above the high of this bar. Why is it okay to take profits here? Well, you got a potential final flag. Odds are very tight channel. The reversal will be minor, which means either a bear flag or a trading range and then more down. But it's okay to take profits here. You have a potential final flag, and look at your profit. You have 7 points profit, which is far greater than 2 times actual or initial risk. So you have a strong trader's equation. The math is okay to take profits here. Tight bear channel, probably going lower. So it's also okay to hold short. probably better to exit here or maybe here. It's about the same price. Here we got a double bottom and we're converting into a tight trading range. So instead of a tight bear channel, now we're in a tight trading range here, 10 bars here, 20 bars. And at this point, you got to be thinking about the possibility of trend reversal up being almost as likely as trend resumption down. So I would get out here or here. So you made 7 points profit. If you get out here, you made 7 points profit. And if you traded one contract after commissions, that would be about $345. If you traded 20 contracts, that would be about $6,900. $5,000 is a magic number for traders. There are over 200 trading days a year, and if you average $5,000 a day, that translates into $1 million a year. When traders are beginning to increase their positions and their profit, so they make $1,000 a day, then they make $2,000 a day, what's the next target? $5,000 a day, because it translates into a very big round number profit at the end of the year, $1 million. Every trader has a dream, right? And you're paying attention to goals. And one goal is $1,000 a day. Another goal is $5,000 a day. In this video, I talked about defaults to use when taking profits. The minimum default is always 2 times actual risk, but sometimes the actual risk is small. And then traders should instead think about using 2 times initial risk as their minimum target for taking at least partial profits. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This video is on trade management and taking profits.